improving. Shares in China also improving as the unrest seems to be quieting down for the moment. So we're looking at futures getting some 0.2%.
Yeah, so we've seen that response, the police response, but also those health officials in China suggesting that they're going to start to tweak some of the measures around the COVID zero policy, and they're going to be targeting that elderly demographic that remains pretty unvaccinated, at least by comparisons to countries like Germany, Japan, even the US. The FTSE 100 currently gaining 0.1%. The Chinese markets have just been storming this morning, recouping the losses of yesterday. We'll look at the Chinese market reaction, the share price reaction, just in the next few minutes. But here we're focused, of course, on the European Open. And the gains then filtering across. The Spanish IBEX up 23 points. The FTSE 100 now gaining 0.2%. We heard from Madame Lagarde yesterday suggesting that further hikes are in the cards. She says she sees it's unlikely that inflation has peaked. We're expecting Spanish CPI out in the next few seconds. The Spanish IBEX currently up 0.2%. Let's switch it over and see how things are looking as we look ahead to the US Open then. The losses of yesterday pairing some of those losses with the futures now pointing up by 0.3%. The dollar is down. The last time I checked, about 0.5%. That's giving a bit of a bid to the euro. 103 on the single currency. That's a gain of 0.3%. There's also money moving in to bunds, German bunds, the 10s and the 2s. This is the 2-year, 207. Look at that. That's a move lower in terms of yields by 11 basis points. So German bunds are bid at this point. Brent oil currently trading at $84 a barrel. Again, pairing some of the losses that we saw yesterday. At some points during the day yesterday, Brent was down as much as 3%, currently gaining 1.8%. We continue, of course, to monitor the negotiations in Brussels about that potential price cap on Russian crude. And briefly checking in then on the Chinese markets, mainland and in Hong Kong, on the back of a little bit of optimism then in terms of what we've been seeing. Yes, no protests overnight, a very heavy police presence in cities like Shanghai, Beijing and Hangzhou, and that commentary from health officials around tweaking the response to COVID. The CSI 300, the benchmark, getting a full 3% over in Hong Kong, 18,187 on the benchmark in that jurisdiction, a whopping gain of more than 5%, and the tech index as well, currently up almost 8%, 7.6% in terms of tech stocks listed in Hong Kong. Francie.
Now, we're getting some CPI numbers out of Spain, preliminary for the month of November. Now, they're important because they do look at the first couple of weeks in the winter months. That harmonized CPI actually rising 6.6% year on year. It's an increase, but it is less than expected. We were expecting a 7.1% increase. In terms of euro dollar, currently 103.76. Let's also dig a little deeper into the sectors that are on the move. Remember, there are 19 industry groups. I have energy gaining 1.5%, retail, basic resources, technology. In fact, there are only 3 groups that are seeing a little bit of pressure, and that is chemicals and telecoms, down about 0.2%. So not huge moves to the downside, Tom. Now let's also get over to our Bloomberg MLive managing editor, Mark Cudmore, with some great, fantastic charts as ever. Mark, you're looking at the U.S. housing market. Good morning.
Yes, Fran, I am very excited by China today. I'm also excited about those European inflation prints, but I'm trying to look ahead. US data later on will also get me excited if I'm not too distracted by World Cup matches. This is a chart of US house prices month on month, going back over the last 20 years. Look at that clickbait headline, US house prices fall like 2008, and that is indeed the case. Today, we're expected to get the reading for September at minus 1.2% month on month. That would be the largest monthly decline since November 2008, 2 months after Lehman went down. In fact, it'll be the second largest monthly decline on records that go back more than 30 years. So what's the difference in 2008? Well, in 2008, we'd actually been falling for more than a year before we got that dramatic final decline, and that was the final part. The difference this time is we've just had the 2 years of just unprecedented house price gains. What that means, in effect, and I'll go to the next chart, is that actually in year-on-year terms, despite we're about to see a large month-to-month drop, in year-on-year terms, house prices are still up massively. And that means there's still a tailwind for consumer spending. So that's the positive. There's still a tailwind. Don't get too dramatic by the month-to-month numbers. The flip side is, and Bloomberg Economics have made the point, they can fall another 15% just to return to the bullish trend. And I guess the takeaway is that, hey, like we've talked about a lot this year, US consumer spending will hold up more than many people think, which is why I still think a US recession probably doesn't start till at least second quarter next year. However, when it comes, it may be much, much more painful because they'll be correcting really, really sharply by that stage. So I think house prices, a lot of pain the year ahead, still a tailwind short term for consumers, but next year could be very painful.
Okay, that house price indicator and potentially a more painful recession, at least kicking off in the second quarter of next year, is the forecast then from Bloomberg's MLive Managing Editor Mark Cudmore. Thank you for that analysis and deep dive on the housing sector of the US. Now, Fed speakers have been out in force once again, stressing that they will raise borrowing costs further to curb inflation. Richmond President Thomas Sparkin told Bloomberg TV that he favoured a slower pace in recognition of past aggressive moves.
Very supportive of a path that is slower, probably longer, and potentially higher than where we were.
Joining us now in the studio is Gordon Shannon, portfolio manager at 24 Asset Management. Gordon, good morning. Thank you for joining us in the studio. So once again, a coterie of Fed officials coming out and saying, yes, the size of the future rate hikes may start to be smaller. Maybe you're looking at 50 basis points, but the terminal rate is likely to be higher and it's likely to be held there for longer than maybe market participants are expecting. Why do the markets continue to look through this? Officials push back as liquidity, or at least financial conditions, ease, and yet the markets continue to believe that we're at a pivot point.
Yeah, that's it. I mean, I think that the euphoria has gone too far, and I think at this point the Fed has shown that they're worried about that. You know, ultimately they're looking at what markets are doing here. Too far. They're trying to talk them down, but in bear markets you get this pressure to get back in, and I think everybody wants to embrace the Santa rally into year end. I'm not sure how much it leaves for next year though.
I mean, the Santa rally needs to be, you know, if there is a Santa rally based on fundamentals, is there any data points that gives you comfort that we've reached peak inflation? Not for me. Headline peak inflation, yes, but core inflation I think is very sticky. I think perhaps in the US we come down to 6% and bounce around there, and the risks are very much the upside at that point. In the UK and Europe, I really don't see any evidence that core inflation has peaked.
We have a chart, hopefully we can get it in time, showing the global bond yield inversion, which we haven't seen for something like 2 decades, just indicating again the risks over recession. How are you starting to factor those risks into the way you allocate?
You can factor them in as late as this. We're long-term investors, so we've been worried about inflation's impact on central bank behaviour and the fact that the tightening there would cause a recession for quite a while now. So it's about rotating into higher quality names. You can't have doubts in your portfolio going into a volatile market like this. How much more volatile are these markets going to be in 2023? I think it very much depends upon the data. If we get more of these upside surprises to inflation that does convince the market that the Fed is serious when they say that the terminal rate has to be higher, you know, I think that's when we could see, you know, another leg down in markets.
There was this note out from Morgan Stanley overnight saying that markets are obsessed, of course, with the rate hike trajectory from the Fed, but they're to some extent ignoring what's happening with quantitative tightening. They described it as the elephant in the room, and you have various market participants judging just what impact that's going to have on equities. Is that something, how closely you're watching the impact of QT? They're looking at downside of maybe 8% in one scenario, maybe 15% in another for the S&P.
Yeah, I mean, I think that's quite believable. The trouble here is we don't have experience of QT. So people talk about things that they're comfortable talking about. You look back at the last 15 years, we've got a lot of data on QE. So everyone's an expert on that. We just don't have the data points in QT, and that's why it's not been given enough attention. But yeah, it's equivalent to multiple rate hikes. So you have to think that terminal rate is that bit higher than we all price in currently. But Gordon, how are markets pricing in? So, for example, some of the UK gilts. So in this kind of environment that you've laid out, what do you buy? Well, I mean, if you look between the standard debt management office auctions and the Bank of England's reduction in its QE holdings, we've got an auction every day for the next 2 weeks, and that could involve in between 10 to 60 billion. Now, that's a small amount in comparison to next year's expected 300 billion of gilt issuance. There's really no part of the curve there which is safe from a deluge of supply.
And to be clear, you think there's fragility, even if the risk premium, the post-mini budget risk premium has come off, there's still fragility within the gilt market.
Yeah, I mean, I've been startled at just how quickly gilts have shrugged off the incompetency premium that was put on them. And again, that's where I think the risks are to the downside there. With these auctions, what you want to watch is the cover ratio. So how many bids versus how much was trying to get done. anything below 2 times, and you've got to be concerned that markets are fragile. You can also look at the tail. That's the lowest bid accepted compared to the average yield. And where that should be under 1 basis point. In times like early October, we saw that more than 4 basis points. So again, if the tail lengthens, that's a sign of fragility in the markets. One of these auctions may fail.
All right, Gordon, thank you so much. Gordon Shannon, portfolio manager at 24 Asset Management, stays with us. Coming up, China's COVID protests have gone global. We'll have more on the remarkable political unrest next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. We are 13 minutes into the European trading day. Risk on as a result of some easing of concern about what is happening in China. You're seeing that reflected in the Hang Seng Index in Hong Kong. That index rising as much as 6.2% as investors bet on a slightly faster reopening. Whether that's naive or not will be something we will see in the weeks and months ahead. Currently, the HSI back down to a gain of a little over 5.2%. The HS Tech Index, by the way, gaining 7.6%. And reflecting, of course, in European equities, currently the benchmark up at 0.3% here in Europe. Francine.
Now, protests against China's stringent COVID regime failed to take place last night as authorities deployed a heavy police presence in the capital and other major cities to deter a repeat of the weekend's demonstrations. Bloomberg's John Liu joins us now from Beijing. John, I was also being briefed, of course, by our very own Tom McKenzie, who spent a good amount of time in Beijing. What's it like on the ground now? How much can people protest, or is the government really slamming down on it?
Well, China's never been a place where protests have been easy. The protests that we've seen over the weekend, some on Monday night tried to go out and protest, but it's always been difficult. The police were out in force. In addition to that, the weather has not been conducive. It's been well below freezing here in Beijing. It's been raining in Shanghai, so that's discouraged people from going out as well. But at the same time, the government has also been trying to address some of the concerns raised by the protesters, loosening some of those testing requirements, opening up the compounds that have been locked down. And so it is been a carrot and stick approach so far.
Yeah, the carrot and stick approach is really interesting, and the market reaction is obviously positive on the back of this, John. Just on that approach, how significant do you think some of these announcements are, just within the context of what's happening on the ground there, and that market reaction? Does it seem reasonable?
I think the market is thinking, well, if the protests are not going to escalate, then maybe this is the thing, that the spark that is going to get the government moving faster on reopening the economy. And there's been a lot of optimism that that's what will happen. We've just had this briefing from the National Health Commission where they talked about stepping up the efforts to get those over 80 vaccinated. That's been a big stumbling block for the country's reopening. Only about 60% of those over 80 have gotten 2 shots. Even less have gotten a booster. And so getting that population protected will be very important to opening up. And also the National Health Commission saying they are doing more to make sure people's complaints are addressed by the local governments. And so a very conciliatory tone, and I think that's helping the market sentiment at the moment.
All right, John, thank you so much. Our Greater China Senior Executive Editor, John Lu, in Beijing. In the meantime, we have quite a lot of news with Italian football. This is a big story in football. Juventus plunged into a crisis after the chairman, but also the entire board resigned. This amid a probe into alleged wrongdoing when it came to financials related to the company's lost 3 financial filings. Now, the dramatic exit, of course, follows an investigation by the public prosecutor's office in Turin. A reminder for the Juventus fans and not. Since 2010, Juventus won 9 consecutive Italian top league titles, also known as Scudetti. The leadership of Andrea Agnelli, of course, was seen as a positive, but his reputation suffered as he also tried to, force in the so-called European Super League. For the moment, Juventus down 6%. I do believe that there's a shareholder meeting on January 18th to appoint a new board of directors.
Remarkable story. I'll continue to watch that for you when it comes to Italian football and the future of Juventus then. Let's bring back Gordon Shannon, portfolio manager at 24 Asset Management, still with us. And I want to return to the China story, Gordon. How are the events that have unfolded in the last few days in China, across that country, informed your view of Chinese assets and how much exposure you want to get them to, either directly or indirectly?
Yesterday, it looked like there was really no way out of this for the Chinese government that didn't involve disorder. Because we have enough data now that when COVID restrictions are lifted, and particularly with a relatively unvaccinated population, you get mass outbreaks. And with that, you will have a certain level of death as well. So that's on the one hand, and that happening is an admission of failure of the zero COVID policy. And what we know is that Xi Jinping doesn't do political U-turns. He doesn't admit to mistakes. But on the other hand, clearly the Chinese people have lost patience with COVID zero. But now all of a sudden, of course, the way is clear. You spin the narrative on it. You say that the virus is very different now, that the deadliness of the Omicron variant is far lower. And that way, perhaps we can have that outbreak. We massage the numbers a little and we can look through it. So at this point, perhaps some of the optimism about China isn't warranted. But for me, really, the worry is if we continue to have disruption in China, that's more inflation that will be exported to the rest of the world. No. And that's my thing, inflation. I'm very worried.
Yeah, and Gordon, I mean, for me, it was striking to hear the Prime Minister of the UK also, yesterday warning against the simplistic Cold War rhetoric against China. And he says, look, we need them because of world growth, and we also need them on climate change. What does that mean, for example, for energy demand? The other big story is, of course, Brent and what happens to OPEC Plus to support that level if it drops off. Yeah, well, I don't think OPEC will be doing the rest of the world any favors there. And if you look at the US, their strategic reserves are almost at zero now. At some point, they're going to want to rebuild those because, some of that Cold War rhetoric is coming from the US. So, for me, again, I think if the way is a little bit more clear now for China's consumption of oil, I think the price is going to rebound quite strongly. And the risks are that it retouches some of the highs we saw.
Right, and tying into the oil story is the dollar story, of course. And JP Morgan Stanley coming out in the last couple of days saying maybe we're looking at peak dollar. Maybe the era of dollar strength that we've seen this year is coming to an end. Would you concur with that? Are you seeing that?
Yeah, even though I probably disagree with, a core part of their story, which is, terminal rates, the market expectations have got those right. I think we can go a bit further and for longer there, which is a bit more bullish for the dollar, but nonetheless, there was a lot priced in. So I agree. Peak dollar has been seen.
Okay, Gordon Shannon, excellent insights. Thank you for coming to the studio this morning. Portfolio manager at 24 Asset Management. Coming up, our conversation with Federico Gonzalez, CEO of the Radisson Hotel Group. That is happening later this hour. Stay with us for that. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Inflation's been stubborner than I would like. And I don't start with the idea of a rate path. I start with the idea of getting control over inflation. And as long as inflation stays elevated, it just makes the case to me we need to do more.
Further tightening monetary policy should help restore balance between demand and supply and bring inflation back to 2% over the next few years.
They will come down, I think. That's my baseline, but they probably won't come down quite as fast as markets would like.
It will take some time, but I'm fully confident that we'll return to a sustained period of price stability.
Very supportive of a path that is slower, probably longer, and potentially higher than where we were.
Only recently moved into restrictive territory, and we're going to have to move farther in order to keep inflation under control. I think we probably have to stay there all during 2023 and into 2024.
Well, Fed officials, they're stressing that they will raise borrowing costs further to curb inflation. Let's get to now the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. A fight seems to be brewing between Twitter and Apple after Elon Musk accused the iPhone maker of threatening to keep the social network off the App Store. Musk also says Apple has cut advertising on Twitter, which he acquired last month. Apple has been one of Twitter's top advertisers, with a spend said to be above $100 million a year. Crypto lender BlockFi has filed for bankruptcy, becoming the latest digital asset firm to collapse in the wake of the FTX fiasco. BlockFi says it will use the Chapter 11 process to focus on recovering all obligations owed to BlockFi by its counterparties, including FTX. The firm has asked clients to refrain from depositing more funds. The London Metal Exchange has defended its controversial decision in March to cancel billions of dollars of nickel trades. It says the move avoided a $20 billion margin call that would have sent the market into a death spiral and threatened the exchange's own survival. The LME's account of the historic short squeeze came as it outlined its defense against lawsuits from Elliott Management and Jane Street. That's the Bloomberg Business Flash. Tom Francine.
Laura Wright here in London. Thank you very much indeed. Let's check in some of the movers then in individual corporate stories that we want to bring to your attention. We're going to start with what is happening with Nestle, then move on to Shell, and then the Italian footballing story of which Francine is an expert, Juventus. But let me start with Nestle. Down for, hold your horses, 0.4% down on Nestle. They've adjusted their revenue. Francine is so keen to hit this story. Nestle have adjusted their targets around revenues, earnings per share growth. They're looking at 6 to 10%. And they may spin off their peanut energy business, going down 0.4%. Shell, this is a big story in terms of their transition. So they have bought for about $2 billion the Nature Energy biogas business. It's going to make Shell the largest producer in Europe of renewable natural gas. And here we go, Juventus, down 7%. Why is that, Francine?
I mean, no one cares about anything else, frankly. I feel like it's the Lacqua curse. I followed two football clubs, Chelsea and Juve, and Juventus plunged into a crisis. The chairman and the entire board resigned because of a probe into alleged wrongdoing related to the company's last 3 financial years. Wow. And so this, you know, we need to see exactly what the investigation crops up, but it's how they accounted for players. And then we'll have a new board January 18th.
Alleged wrongdoing at Juventus, the board resigning. There you go, the deep dive with Francine Lacqua. Some of the corporate stories we're watching today. Coming up as well, we're going to be joined by, this is a good one, the CEO of Athex Group, the owner of the Athens Stock Exchange, talking about the Greek economy, the opportunities around investment in that economy, and what the IPO pipeline is going to look like for 2023. Stay with us. That is next. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories.
Risk returns. A rebound in Chinese shares pushes global stocks higher. That's as unrest over COVID curbs eases amid a heavy police presence. Tightening till, Fed officials stress the need for more hikes to break scorching inflation, even if at a slower pace. Plus, BlockFi, yes, it has gone bust. The crypto lender files for bankruptcy. It is the latest victim of the FTX fallout.
Now, Tom, if you look at markets, so look, we're definitely risk on. I know you have some great knowledge of what's happening in China. So you look at that in context of there's less political unrest, there's more hope that China relaxes COVID measures and so helps the world a little bit economically.
Yes, those combination of factors, absolutely, Francine, which was the expectation that maybe you're going to see protests continuing. That didn't happen overnight. And as you say, you had health officials coming out and moderating this response. And you're kind of seeing a granular change, which is leading to some optimism. And the optimism is not granular. The optimism is pronounced. Over in China, the benchmark up 3%, and over in Hong Kong, the benchmark, the Hang Seng Index ended up more than 5%. That has fed into the optimism that we're seeing in the European markets. The benchmark up 0.4%. This is despite the fact that Fed officials, as we said in the headlines, came out again and said, yes, the pace of hikes, at least the size of hikes, may moderate, but the terminal rate is still likely to be higher and left there for longer. The DAX currently up 0.2%, 26 points. Here in the UK, the FTSE 100 gaining 0.8%. We'll see why when we break down the sectors. It's another boost in terms of energy and basic resources. Iron ore is absolutely soaring, and oil is back up again today in the session, tied to the optimism around China. There's your sectors then. Top of the list, basic resources gaining 2.4%, energy up 1.7%. We look ahead to the OPEC Plus meeting over the weekend. At the bottom of the list, chemicals and telecom down between 0.3 and 0.5%. Francine.
Now let's turn our attention to Greece, and the economy has actually continued to recover from the pandemic, but as the impact of the energy crisis and inflation hits, it will likely slow in the coming quarters. However, the Greek economy is performing better than many others in the bloc, and according to a recent EU report, Greece has met its post-bailout targets.
Okay, for more on the economic and investment outlook, we are joined then by Yanis Kontopoulos, who's the CEO of Athex Group, the parent company of the Athens Stock Exchange. He's in town for the Greek Investment Conference, bringing some of the biggest executives, the biggest names and companies to the UK as part of that conference. And the Prime Minister was here early in the week as well, the Greek Prime Minister. Yanis, thank you for joining us in the studio. Let's start there then with the relative resilience of the Greek economy. As you look into 2023, what is your forecast with your economist's cap on as to how well that economy holds up into next year, given the challenges?
Well, I was told when I was having my previous hat that when macro dislocates and markets move in unison, you better find some idiosyncratic story to hide, or at least make your returns differentiated every year. So looking at 2023, Greece hopefully will be one of those examples. I think it did stand out in 2022, and given I think what's baked into the cake, 2023 was going to be one of those years that it's good to be Greece for a change. So yes.
Okay, it's good to be Greece, and it's good to be Greek. But Yanis, overall, what are the capital markets telling us? So if you look at some of the IPOs, some of the pipelines, I mean, we're still looking at a shift for Europe, immense energy pressures, and of course, euro is not helping.
Well, look, Greece is coming from, I would say, probably nowhere in the past few years, but I think that's just a bit of a lag indicator, and the pipeline is getting a bit more interesting. Look, the one big ticket item that will make a huge difference, I think, even in European terms, would be the Athens International Airport, which the government has changed strategy, and it's thinking that it might float in the stock exchange in the course of 2023, and that I think will attract a lot of international attention. It's a good investment for Greeks on the retail side, so I think that could potentially just kick in and make a difference.
So that's the Athens International Airport potential IPO in 2023.
Correct.
Is that likely to be a catalyst and motivate others to come to market within this environment?
Absolutely, yeah. I think, look, you have a number of different sectors in Greece that are underrepresented, and they've been doing pretty well in this very weird economic cycle. Shipping has been doing very well. Tourism, obviously, as I mentioned before. Real estate in Greece also has picked up after many, many years. So it's in a way you can look back and say, oh my God, nothing is happening, and you can look up, forward and say, it's all opportunities. Just if we can just get things started.
I mean, to create opportunities, you need initiatives to attract capital. So,
Correct.
What are some of the initiatives that you want to put in place, and are there specific sectors that you're trying to target?
True. Well, look, I'm here, so that's one of the minor initiatives here, not just me. Obviously, the major listed companies in Greece. I think a group of very significant international companies that joined us yesterday and today. Prime Minister came in and his chief economic advisor. All of this is generating the right interest because we have a very good story to tell, as I said, idiosyncratic story. And indeed, actually, the Greek corporates have performed at record pace, both in last year and this year. And so that's you have a recipe to deliver something really good. Now, in terms of other initiatives, I think what will make a huge difference going forward will be for Greece to actually go back into developed market status, which is the equivalent of the investment grade for the country. Now, you need to cover all technical issues on that front. I think we're done with that. And then basically is working on the perception. It's like economics, right? Confidence makes a huge difference. So how you are perceived by the market will determine on whether they think that you are a developed market, and then they will grant you that status. It's a little bit, as Soros would say, is a bit reflexive, but that's the nature of the beast.
And part of that confidence will come from a view that there's political stability in Greece. And I just wonder, given recent history, and look, we're sitting here in the UK, we're very aware of political instability and political chaos.
Yes.
But Greece has not been immune to that as well over the last few years, of course.
No, we have a PhD
history.
on that.
Yeah, you've done pretty well on that with your PhD in political chaos. And maybe we can learn something from you. Next year, there's going to be elections. How concerned are you about political instability returning to your economy?
Look, the important thing is whether the Greeks learned something out of this, and I think they did. We will see how things pan out, but it's an electoral year, and that always poses question marks. But I think at the end of the day, the people have had recent experiences, and they will. It's a bad strategy to underestimate your population, right? I think they'll do what they'll assess is better for them. So. And I think, look, from my experience as an economist and a strategist, more often than not, actually politics don't matter. It's a good topic for us to talk on the news, and people do care about it, and it's lively debate, but most times doesn't actually make a difference.
I mean, in the UK, it made a pretty big difference, certainly, to the pension fund system. So, politics do matter if you do things that the market does not like. What kind of advice would you give to
Absolutely.
the UK?
It's the elections that don't matter necessarily, but politics and policy does.
Elected. Yeah, so what kind of advice, as a Greek that's lived through the crisis, would you give to the UK now?
Stick to what you know. I think that's. The UK has great traditions, and they know how to do things very well. And I think it's very easy to just tilt and go to the right direction.
Talking of tilting, I just want to pivot away and back to a comment you made. You talked about the shipping companies, and of course, when you think of the Greek economy, you think shipping, you think tourism. Why have you failed to attract the shipping companies to list in Athens? Is that an effort that you're going to accelerate, or have you given up on that?
No. Look, it's the first thing that I realized and that surprised me as I arrived 6 months ago. And I said, how is it possible not to have any shipping companies listed? So yes, it will happen, by hook or by crook. That's one of my targets. But I should say that for a change in the last couple of years, we've had shipping companies for the first time listing corporate bonds. So, what you do there is actually a pretty similar process in terms of listing. So we are warming them up. I think we're getting closer. Maybe next time I'll have news on that.
How many companies do you think will be listed in 2023? Like, what are your targets, and how many will IPO?
I don't have a target of companies. I want good products. I think that's the only difference in a stock exchange. If you bring the right product, the rest will follow.
All right, Yanos, thank you so much. As ever, Yanos Kontopoulos there, Athex Group Chief Executive Officer. Now, coming up, our conversation with Federico Gonzalez. He's the Chief Executive Officer of Radisson Hotel Group. That's going to be a good conversation on hotel prices, hotel bookings, and, of course, inflation. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
Welcome back to the Open, everyone. 41 minutes into the European trading day. You can see you're seeing a little bit of lift. Actually, stocks are climbing. This in part because the nationwide unrest that we saw in China yesterday seems to be easing a bit, and that's boosted sentiment for riskier assets, Tom.
Okay, let's get to what's happening in the tourism sector now. Digital systems and sustainable processes are among the key themes being explored by CEOs from hotels, including Hilton, Marriott, and Radisson, who are attending the World Travel and Tourism Council Global Summit in Riyadh. Bloomberg's Yusuf Gamaluddin is on the ground, and Yusuf is bringing us a really important interview. Yusuf.
Thanks, Tom. I mean, I know you and Francine are big travelers, and so I just wanted to see kind of what's happening in the industry. There's a real buzz that's mounting here at the Palace in downtown Riyadh. But I'm pleased to say we're joined by one of the bigger brands globally, and that is Radisson. Let me introduce you to Federico Gonzalez, who is the CEO of the hotel chain with, 1,700 hotels in operation and development. Before we get to Saudi Arabia, I just want to get your view on current events. We have protests in China around zero COVID. You have quite a bit of presence there. How are your operations being affected? Yes. And how is that maybe altering your ability to deliver to customers?
Good morning. I think, when you work in hospitality, you need to think that hotels takes time to find them, it takes time to build them, and then it takes time to operate them. So when we look to the time span of a hotel, usually it's contracts, businesses of 10, 15, 16 years. So I think in nearly any moment in history, there are events. So I think one of the benefits of playing from a global point of view is that there are always situations that are complex that are somehow helped by other situations. If you look to the world today, as you say, China today is still slow. Okay, it's not finishing yet to open as we would expect. But at the same time, you have Middle East that is really doing phenomenal. I think you have the US that is doing extremely well. You have countries like India that are doing extremely well in terms of growth. You have many of the European destinations nearly at highest levels in terms of pricing, okay, even higher than 2019. So I think you have good and bad elements, but I think all in all, I think the industry is recovering well. The level of pricing is slightly higher.
We'll get to some of the details in a moment. Just in terms of the outlook for China 2023, so you're still positive on the whole. You think this is a speed bump in the road, as it were. One of the comments you made over the course of 2022 was that you were struggling to fill 1,500 job roles at Radisson.
Yes.
How has this evolved? Maybe it's evolved now to either a hiring freeze, maybe you're beginning to cut roles, given that the global economy might be looking at a serious recession in 23.
I think we have found at the end, we need to find solutions. But I have to say that the solutions are very different on a country-by-country basis. In some places, we have had to adapt and to adjust the salary levels. In some other countries, we have had to increase the level of flexibility. And in other countries, we have got some help with some more labor force being available during the last 6 to 9 months. And I think, hopefully, that will continue. I think working in hospitality is I think, an amazing career opportunity for many people, and I think we should grant that everybody can get access to it.
Inflation is still very much present in a lot of the markets you operate in. What are you doing to mitigate that, and how would you describe the impact so far on margins?
Well, I think, as you say, inflation is creating a lot of pressure from a salary point of view, a lot of pressure in the energy component, and across also all the food chain. I think at the end what we are trying to do is translate the inflation to the market pricing of the hotels. I think at the end, me as a consumer, I suffered inflation that as anybody else. But I think at the end a hotel is not different than to have a small shop. Okay, and at the end of the month, the owner of the shop needs to come home and say, here I have my monthly income. And I think all of us would react saying, I need to optimize some costs. I need to do things in a more optimal way. But at the same time, I need to recover. Okay, and I need to make sure at the end of the month, when I go home, we all have the same amount of money, or if not more, because of inflation that I used to have.
Let's talk about the kingdom. Very ambitious plans. They want to become the top tourism spot by 2030, 100 million visitors per year. You think that's realistic, and how are you taking part in that potential success story?
Yes, I think what is happening in Saudi today is pretty unique. I think we have not seen, I would say nearly ever, okay, a whole country raising their voice and saying we want 100 million visitors, okay, in a very short period of time, and at the same time putting the means to do it. I think when you come, last time I came in May. Just between May and now, there are significant changes, and when you see, all the videos that they showed are real. So it's not science fiction. It's really change is happening, and I think when you see willingness to change, but then supported by the means to change, and that means, the kingdom is putting means in terms of people, in terms of infrastructure, in terms of partnerships, in terms of willingness to innovate. I think you need to be here. I think you need to be here. You need to be more often, actually, because it is true that the kingdom is still very much unknown, okay, outside the kingdom. And I think in our case, I have to say we were one of the first operators in the kingdom many years ago.
Absolutely.
We have 25 hotels operating and 20 in development, 45.
So a strong presence. Just if I could get some closing thoughts on sustainable travel, because it's one of the themes here.
Yes.
I wonder whether consumers are really willing to pay for sustainability. I mean, how do you build it into the business model?
Yes. I think when we talk on sustainability, first we need to think sustainability has 3 dimensions, okay? It's not only the environment, it's the people, and it's the communities where we operate. And then second, people need immediate sustainability. When you go across the industry, everybody's in agreement to what will happen by 2050, right? But most of us would not be here in 2050 when that happens. I think what we are asking and working with organizations like WTTC or the SHA organization is make sure that we have things happening now, things happen in the very immediate future. That's why we launched Hotel Sustainability Basics. It's 12 very easy things that each hotel in the world can start implementing now.
Yeah.
Meanwhile, 2050 arrived, there is a lot of action, and I think when the consumer will see it, they will realize that things are changing. And the second point is, when you look to those things that will impact sustainability in the short term, they don't necessarily have a higher cost. Actually, that helps very single hotels rethink many of the things we do and do it in a better way.
Federico, great catching up. Thank you for making time in your busy schedule. I know you've got a lot of meetings lined up. That's Federico Gonzalez, the CEO of Radisson. That's a bit of a snapshot of what's happening here on the ground. Fran, Tom?
Thank you so much, Youssef. Youssef Gamaldin there covering the 22nd Annual World Travel and Tourism Council's Global Summit. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Thanks, Francine. China says it's going to ramp up COVID vaccinations for senior citizens, a move regarded by health experts as crucial to removing tough COVID zero curbs. But Beijing stopped short of announcing mandates for compulsory jabs. Last night saw a heavy police presence deployed in major cities, which prevented a repeat of the weekend's protests over anti-COVID measures. Christine Lagarde says she would be surprised if Eurozone inflation had peaked. The ECB president's comments suggest the central bank's recent ramp-up in interest rates is not close to being over. Speaking to lawmakers in Brussels, she also warned growth will continue weakening into next year. The UK government has scrapped plans to regulate legal but harmful speech from its online safety bill. The legislation's proposed new offence, which would have applied to social media posts sent with the intention of causing harm, had been criticised by free speech campaigners. The much-delayed proposals are due to be debated in the British Parliament next week. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura, thank you very much indeed. Coming up, BlockFi, becoming the latest crypto casualty as it files for bankruptcy. We'll get the details. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Welcome back to the Open. Happy Tuesday, 54 minutes into your European trading day. You are seeing European equities bid risk on today on the back of easing concerns around China and announcements that the COVID restrictions will be eased, at least on the margins. And looking through then, apparently officials, comments out of the Federal Reserve officials suggesting that the terminal rate is likely to be higher and held for a longer period of time, even as the size of future hikes may be lower than the 75 basis points they have pushed through at the last four meetings. Currently seeing gains then of 0.3% across the benchmark. Also worth noting, Spanish inflation coming in slightly lower than the estimates, significantly lower than the previous month, and that is leading to a bid for European sovereigns. You're seeing that marked in Germany, the Bunds, Italian BTPs, and Spanish debt as well. You can see a 15 basis point move lower in terms of Italian 10-year BTPs at 376. The Spanish 10-year 287. That's a move lower by 12 basis points. And in Germany, the Bund, the benchmark 188, down 10 basis points. So that's a marked move on the back of slightly softer inflation. We're going to get more German inflation, European inflation out in the next few hours as well, Francine.
Now, these are some of the stocks on the move. I have to say, I love chocolate. I love football. The one that's kind of getting in the way is Shell. So I'll let you do Shell, but these are the other ones. So first of all, Nestle, because it's trying to boost sales growth and, of course, increase profitability in a pretty ugly inflationary environment, this morning may sell its peanut allergy business to help meet some of the new profit and margin goals. The other big story, and this is a huge story in football, Juventus plunged into crisis after the chairman, but also the entire board resigned amid a probe into alleged wrongdoing. This is related to the company's last 3-year financial filings. Again, the club has denied any wrongdoing, but we understand that there could be a potential problem with the review of how players were accounted for. Juventus down some 4%, Nestle also down 1%.
Okay, so you take chocolate and football, and I take decomposing agricultural waste. Yes, this is a company that Shell has bought for about $2 billion US. It's called Nature Energy Biogas, and it creates that gas using decomposing agricultural waste. How glamorous. It is part of Shell's transition to renewables and away from fossil fuels. It's obviously a pretty sizable deal. It's going to make Shell the largest provider and producer of biogas in Europe. That's a gain of 2%, investors rewarding that. So broadly, as we said, markets risk on. The futures in the US as well, also looking higher to open higher between 0.4 and 0.6% after the down day that we saw yesterday. Investors still weighing those comments as well from Fed officials, but it's really all about China and the momentum there. Chinese stocks ended up on the mainland more than 3%. That is it for the European market. Open surveillance early edition is up next. Francine is sticking around. Stay with us. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Risk returns, a rebound in Chinese shares pushes global stocks higher as unrest over COVID curbs eases amid a heavy police presence. Tightening tilt while the Fed officials stress the need for more hikes to break scorching inflation, even if at a slower pace. Plus, Musk rounds on Apple. The billionaire owner of Twitter attacks the iPhone maker in a flurry of tweets, risking ties with a top advertiser. Now, first things first, we do have some interesting stories we need to get to, but this is what the picture looks like for the markets. Getting 0.2% for European stocks. Look, there's a very clear move into risky assets after some of the concerns that we had over China and some of the protests yesterday. And the contribution, of course, of China to the world economy abated somewhat. China said it would bolster also vaccination amongst its senior citizens. And then we had some pretty encouraging figures in terms of CPI in Spain, and that's changing what we look at in terms of bond markets. We'll get to yields overall in Europe shortly. Crude oil, 79.02. This WTI, I could also be looking at Brent, and then S&P 500 futures gaining 0.5%. Now, the European map, if you look at some of the affinities or not with the energy crisis and the proximity to Russia, you can see the UK gaining 0.7%. We have a really interesting story on the Bloomberg terminal about house prices, certainly that prime house prices, according to an index by Knight Frank, will go down 3% in the UK, Dubai taking that top spot. And then you can see the DAX and the FTSE MIB over in Italy pretty much unchanged. Now, Bloomberg's Chief Asia Economics Correspondent, Enda Kern, joins us, and all of the news related to China and what we've seen over the last couple of days. Enda, thank you so much for joining us. How should we look at China? How should we look at the contribution China going forward will do to the world economy?
Well, we had news today, Francine, that the government is going to target the elderly population in particular for vaccination. It's going to push vaccines among this part of the population, especially in nursing homes. They will use the data to identify who does need a vaccine or a booster shot, because that part of the population, those aged 80 and above, are among the under-vaccinated in China's population. Now, the government today stopped short, however, of enforcing mandates or providing specific details of how they're going to do this. But the point of it all is, analysts are saying this shows you that China is now on a long road out of COVID-0. Eventually, they are preparing to make that journey. That's why we saw markets respond the way they did today. A big rally in individual shares linked to vaccines, for example, and of course a broader rally that the economy might start to pick up. So it was obviously, of course, the backdrop being those protests in recent days that would have certainly not have gone unnoticed by the government, met with a fairly stiff police response. But the net takeaway, I think, for most people watching the China story today is that it's a small incremental step on what's going to be probably a long and maybe complicated journey for China to transition away from its COVID-0 policies and back towards reopening and connecting its economy with the world.
So, and how difficult is it to actually game theory what happens in China? We know that they're using police sensors and other tactics to avoid some of the protests. Do you assume that protests will slowly peter out?
Well, politically speaking, we know there's always going to be a very tough response to protests in China. What our colleagues are reporting on for the past few days is quite unprecedented, Francine, and it was met with that stiff police response. There are other factors at play as well. Our colleagues were saying, for example, the sub-zero, freezing cold temperatures in Beijing probably played a role in all of that. We'll need to see how the protests play out over coming days and the weekend in particular. But the bigger point is that there are some signs now that the government is trying to tweak its COVID-0 strategy, at least move away from some of the rolling cycle of lockdowns and restrictions, try and let the economy get back on its feet, and of course, to let people get around and improve mobility. That seems to be the takeaway from the steps in recent days.
All right, let's also bring Janet Moy of Brewin Dolphin, head of market analysis there, RBC Brewin Dolphin. Janet, when you look at China, and you're of course also a China expert, and you've given us insight over the last 10 years, is this a pivot point for the Chinese economy on how many vaccinations they'll do for the older members of the public and what it means for the world economy?
Hi, Francine. Good morning. Thanks for having me. Yeah, we think this is quite a pivotal moment because we haven't really seen this kind of broadcasted widespread protests in China. So I think the people have spoken. it's been too long, and I think the officials, I think they got the message, and that's why we got the press conference today, a bit of softening in the tone. So I think the overall direction is still, gradually easing that very strict COVID-0 strategy. So it is a good thing, but it is going to be done in, a two step forward, one step back kind of process. It's never going to be easy, and the market will be very, very sensitive to the developments. But overall, I think is a positive trend.
So, Janet, overall, what does it mean for China's contribution to the world economy? Are you also expecting less lockdowns going forward, or how does that develop?
Yeah, I think if the current situation stands, we do expect that the lockdowns will be more infrequent because there is a macro and the top-down guidance of gradually easing policies, and I think the regional officials also get that. So we expect more easing measures, more activity going forward from the consumer side of things. Services side has been absolutely hampered by the zero COVID strategy, so it would be very positive domestically. And from a global perspective, there has been a lot of concerns on the ongoing disruption to global supply chains. I think that would alleviate that concern, and that would help to further dampen that global goods inflation story.
And so, Jen, overall, does it directly impact, energy in the immediate terms? Or is it oil and energy prices, or is it just the supply chains that we need to look at?
Yeah, I think so. We have seen oil prices slumping basically in the past months or so, and I think a big part of that is due to China still not reopening. But I think if there is more concrete evidence that China is going back to its normal, it will be very positive for the commodity sector, especially energy and also gas. We've both seen prices slumping quite a lot. So it will be short-term positive, but longer-term factors, of course, that still depends on the Russian side of things, the OPEC supply side of things. But yeah, it will be positive for the oil and gas.
So, Jen, overall, are we reaching peak inflation? I know there's you can see peak inflation, but core inflation being very, very sticky. And is this the point where finally the market realizes what Fed officials have been trying to say, that maybe they'll ease off, but the trend is definitely higher interest rates?
Yeah, we do think that we are seeing peak inflation. We are seeing that in the US in terms of the headline. The core is still very sticky, but eventually that would also turn because of the slowing housing market. First of all, that will have a more significant impact on demand, general demand next year. We're not seeing that yet, but next year probably more noticeably. And we think there are many leading indicators that tell us inflation is peaking. You see basically producer prices slowing across the world, food prices slowing, all the commodity complex slowing from the peak. The strong dollar is very supportive for the imported goods side of things, and eventually we're going to see a slower labor market. So I think all that points to some sort of slowing inflation in next year.
And I know you've written some wonderful analysis, of course, on central banks and some of the challenges going ahead, looking into 2023. What kind of juncture do you think? I don't know whether we're at crossroads, because there's a belief in the markets that actually inflation will come down, and that's not exactly the message we're hearing from central banks.
No, I think that's the biggest question, Francine, for next year. There is a view that we've passed peak inflation, certainly maybe in food prices and in certain commodity prices. Obviously, the European energy crisis is a standout from that, though. But the big question is less about has inflation peaked, where does inflation come back to? Does it plateau at a high level, or does it come back to somewhere that the central banks are comfortable with, somewhere near those mandate targets that you all have to observe? That's probably one of the biggest questions, and that by extension will dictate where, of course, interest rates go and where people's mortgages will go next year. And that, of course, will dictate a lot of, the whole consumer animal spirit story and the pressure in the housing market that we've seen across the developed world, especially this year. So I think there is a lot of focus on, I think, less about the peak inflation story, but where does it come back to? Does it settle at a high level or come back down to where central banks wanted? That's the big unknown for next year.
Yeah, and Jen, if you look at that big unknown, of course, how do you play that on the markets? You just go into bonds.
Yeah, so in terms of equities versus bond, we think that bonds are more attractive than equities at the moment, because I think markets are pricing in a lot of interest rate increases already. Basically, we're not, the bulk of that interest rate increases has happened, and we're not far from the peak, basically. You can speculate whether it's, in the US it's 5 or 5.25%, but we're nearly there. So we think that bonds overvalue, especially, the yield curve is flashing these recession signals, and it's our base case that there is going to be a recession sometime next year in the U.S. So bonds would be a asset class that perform in that sort of environment. And equities, where we don't have a strong conviction yet, because we think that the earnings downgrade and the recession next year is going to potentially hamper equities further.
All right, thank you so much. Janet Moy there, head of market analysis at RBC, Brewin Dolphin, and Bloomberg's chief Asia economics correspondent, Enda Kern. In terms of market moves, also watch out for European yields. That Spanish inflation number actually eased more than expected, and that will probably give a little boost for the ECB, reinforcing expectations for a wider slowdown in European prices and maybe offering some comfort to governments. Coming up, Twitter boss Elon Musk says Apple has cut back its advertising on the social network. So we'll have plenty more on that story next. And this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacrediere in London. Now, BlockFi has become the latest crypto casualty as it files for bankruptcy, citing FTX exposure, with the FT reporting it's suing the FTX founder, Sam Bankman-Fried. Now, joining us now is Ana Herrera, our senior crypto editor. Ana, I mean, first of all, it feels like every day, every week, maybe not every day, but every week, there's something going wrong with a part of someone that had exposure to a crypto market. So what's happening with BlockFi?
So BlockFi wasn't doing well already because they were exposed to the fall in prices, obviously, because they're a lender. They were bailed out by FTX, and we know that now FTX needed a bailout, and they've gone bankrupt. So obviously they're exposed to FTX, and that's sort of what drove them to their bankruptcy. And clearly, obviously, they're probably not the last because they had their own counterparties, and we've not been able to see from sort of their filing who their major counterparties are. I think we saw the SEC creditors. We saw the SEC is one of their major creditors, which is funny, and I guess in a way, but still there might be more dominoes to fall when we figure out who the other counterparties and creditors might be.
So what's the market reaction? You're right. This is like an ecosystem, right? So it's lenders. They're all intertwined. How difficult is it to find out who's next?
Yeah, you'd think that it'd be easier because of blockchain, blockchain transparency, everything is there. But really, like, a lot of these exchanges and centralized institutions are sort of like black holes. You don't really see what's going on. So it's hard until, you actually see the creditors list to figure out who was exposed, or if they come out and say, some firms have said we were exposed. but obviously, like, it tends to be the ones that where maybe the exposure isn't completely like too big, or where they want to minimize contagion. We don't know really if keeping the names not open is actually helpful or not, because in a way it might like slow down. People might be thinking, who do I trust now? And so that might be stalling things.
So are you expecting more pain until, and I don't know how long that pain lasts until we find out who the last domino is?
Yeah, we don't really know. This has really started earlier on this year, so it's actually continuing since May. We had a bit of a lull in pain, but it's back now. We were watching Genesis last week. They were raising money, and they said if we don't raise money, we might file. So obviously we're trying to figure out and trying to wait and see if they've raised money or if they're going to file as well.
All right, Anna, thanks so much. Anna Herrera, they're our senior crypto editor. Now, from crypto to Twitter. Elon Musk has tweeted that Apple has mostly stopped advertising on Twitter. A few minutes later, the Twitter chief claimed Apple might boot Twitter from its App Store. Now, for more, we're joined by Bloomberg's Giles Turner. Giles, I mean, so much drama in the Twitter sphere. And what is this? Is this Elon Musk just baiting and picking fights?
I get a feeling that he's come into the office and realized that Apple gets a 30% commission for all the money that he can possibly make via the App Store, because the real problem is Twitter needs to make money, right? Yeah. He's bought this for a huge amount of money. It doesn't make a huge amount of profit, if any. He wants to charge $8 for every user to use Twitter, and Apple's going to get 30% if he ends up managing to charge people, $8. So he's realized this and thought, I need to take them on. But all this has been done before. Epic Games has had a huge fight with Apple, went to the law courts. This is the time in 2019. This is the company that made Fortnite. Every kid was playing that game, on their mobile, and they lost, right? And so let's see if, Elon Musk, is he going to go to the courts again, or is he going to try and bully Apple? It's very hard to bully the biggest company in the world, so it's going to be a fascinating fight.
I mean, is Apple also a huge advertiser on Twitter? So does it impact revenue on that front?
Yeah, Apple's one of the biggest advertisers on Twitter. I think it's a huge amount. They do advertise. Most of Twitter's revenue comes from advertising as well. I think it's about 4.1 billion last year. Apple, I mean, we saw in the Twitter fight, Apple's pulling back from advertising. So is everyone else, right? They're not the only one. So this is a huge problem for them.
So does Elon Musk have any leverage in the
I think he has some. It helps owning Twitter, for example, the place that most people like to pick a fight. But also, Apple doesn't advertise on Facebook, for example. I mean, Apple's got an amazing advertising machine, but it did really focus on Twitter. And so pulling back from that, I'm sure they'll find ways of selling their goods. They don't have a problem with that. But still, it's not a great fight to pick.
Giles, overall, I mean, I watch Twitter all the time, and it's really Elon Musk tweeting like 24/7. Is this working? Is it too early to say whether people are leaving the platform or coming back to the platform? Like, it's unclear exactly what's happening right now.
Well, he says it's going great, but I guess he would say that. But I think with this particular fight, this is a really good fight for him to pick, because lawmakers both in Europe and the US don't like Apple charging 30%. Yeah. It's a gatekeeper. They think it should be fairer. This is a fight that he could potentially win, because he's got a lot of, especially Republican lawmakers, on his side with this. Yeah. And you can see him doing plenty of lobbying in the politics sphere with the upcoming US election. So maybe this is all part of that. And maybe this is the fight he could potentially win, or at least bring down that 30% figure.
I mean, he would have known this before, right? That they charged 30% because of the Epic fight.
I don't know. I couldn't say. Sometimes I get the feeling he comes in every morning, learns a new thing, and then says it on Twitter. So I can't say.
All right, Giles, thank you so much, as always, for your insight. Giles Turner there from our media and tech team. Now, the other thing we're watching is European football. Yes, this is Juventus plunged into crisis this morning after the chairman, but also the entire board resigned amid a probe into alleged wrongdoing related to the company's last 3 financial findings. Also coming up, Paul Mashatile, tipped to be the next deputy leader of South Africa's governing African National Congress. He already holds 3 of the party's top positions. We'll get his views on reviving the economy. This is Bloomberg.
has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Inflation's been stubborner than I would like. And I don't start with the idea of a rate path. I start with the idea of getting control over inflation. And as long as inflation stays elevated, it just makes the case to me we need to do more.
Further tightening monetary policy should help restore balance between demand and supply and bring inflation back to 2% over the next few years.
They will come down, I think. That's my baseline, but they probably won't come down quite as fast as markets would like.
It will take some time, but I'm fully confident that we'll return to a sustained period of price development.
Very supportive of a path that is slower, probably longer, and potentially higher than where we were.
Only recently moved into restrictive territory, and we're going to have to move farther in order to keep inflation under control. I think we probably have to stay there all during 2023 and into 2024.
Well, Fed officials, they're stressing that they will raise borrowing costs further to curb inflation. Now let's get straight to the Bloomberg First Word News. Here's Laura Ryan. Hi, Laura.
Hi, Francine. China says it's going to ramp up COVID vaccinations for senior citizens, a move regarded by health experts as crucial to removing tough COVID zero curbs. But Beijing stopped short of announcing mandates for compulsory jabs. Last night saw a heavy police presence deployed in major cities, which prevented a repeat of the weekend's protests over anti-COVID measures. Christine Lagarde said she would be surprised if Eurozone inflation had peaked. The ECB president's comments suggest the central bank's recent ramp-up in interest rates is not close to being over. Speaking to lawmakers in Brussels, she also warned growth will continue weakening into next year. UK Prime Minister Rishi Sunak says the so-called golden era of British relations with China is over. In his first major policy speech, Sunak said Beijing cannot simply be ignored, especially on issues such as global economic stability or climate change. He says the UK will work with allies to manage what he called sharpening competition with China. Hawaii's Mauna Loa, the largest active volcano on Earth, has erupted for the first time in nearly 4 decades. Local officials opened emergency shelters after the volcano began erupting late Sunday, blanketing the sky with ash. Officials have not issued evacuation orders and air traffic remains unaffected. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Francine.
Laura, thank you so much. Laura Wright in London. Now, let's also look at what Juventus is doing. The share price for Juventus dropping after the chairman, Andrea Agnelli, and the entire board has resigned. Now, this is a pretty dramatic exit. It follows an investigation by the public prosecutor's office in Turin and Consob Italy's market regulator into some of the football club's recent financial balance sheets regarding alleged false accounting and market manipulation, something that the club has denied. They have denied any wrongdoing. Just a reminder, Juventus currently ranked third behind Napoli and AC Milan in Italy's top football league, that's Serie A. In the meantime, this is what the markets are doing, a bit of a lift-off for these European stocks. They opened higher. Nationwide unrest in China over COVID curbs seem to be easing, and that's boosting sentiment for riskier assets. Coming up, we go live to the World Travel and Tourism Council Summit in Riyadh to discuss post-COVID travel trends and expansion plans with Accor's chairman and chief executive. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Your top stories today: risk returns, a rebound in Chinese shares actually pushes global stocks higher as unrest over COVID curbs eases amid a heavy police presence. Tightening tilts, Fed officials stress the need for more hikes to break scorching inflation, even if at a slower pace. Plus, Musk rounds on Apple. The billionaire owner of Twitter attacks the iPhone maker in a flurry of tweets, risking ties with the top advertiser. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, leisure companies have been seeing travel rebound post-COVID, but rising inflation also presents a challenge for the outlook. Let's go straight to Bloomberg's Youssef Gamael-Din, who's at the World Travel and Tourism Council Global Summit in Riyadh. So, Youssef, over to you.
Yeah, thanks, Fran. Just people left and right, real buzz that continues to build here at the WTTC. I'm happy to say that we've been having quite a few conversations with top brands, and we need to add another brand to them. That is, of course, Accor. Very pleased to be joined.
The last one.
By best for last.
Absolutely.
Right? Yeah. Chairman and CEO Sebastian is a good friend, of course. Talk to me about this whole concept about pent-up demand, because I'm getting a bit tired of it. Because everybody's basing their outlooks for the end of this year on pent-up demand. How much of that is really going to carry through to 23 and 24?
Well, we're pretty convinced it's going to be carrying at least for the first quarter of 2023. First semester, I don't know. 2024, I have no idea. No, seriously, with what's happening in the world, with inflation, with maybe recession, thank God we had a good 2022. I think we're going to have a good first semester 2023. And then the odds are, I don't know. But I'm a true optimist, so it was better recovery than we expected, stronger demand. And so it should be carrying on as long as people have the wherewithal to travel and money to spend on leisure.
You've made some big bets on China, as have many others in the industry. You've seen the images over the weekend coming through in terms of the protests, zero COVID policies. Yeah. How does that weigh on your outlook for the new year? I mean, does that change anything for you at the moment? What are you hearing?
No, it's too late to change anything anyhow. So I guess you just have to make a long-term bet on China. We've been in China for 45 years. So another year and a half of hiccup, I can cope with this. So, I mean, you know, we need the Chinese travelers to come back outside of China, but we haven't seen them for the last 3 years. So we probably won't see them until summer at best. Good news is the Chinese hospitality market is today in the hands of 93% Chinese customers, and it works. It actually works better than I expected myself. So I need the Chinese outside of China, but I'm probably okay with Chinese remaining closed for the international travelers.
Now, a lot of CEOs have been coming here to Saudi Arabia to try and sign additional deals to, I guess, make up for weakness elsewhere. Have you been able to make any new progress? I know you've already got quite a bit in the pipeline.
Well, we moved, first of all, you said we're moving from the doom and gloom of Europe to come here to recharge the energy as if you were going to Singapore.
That's what you said.
That's why I'm actually beginning to get a kind of actually supplemental energy. Now, there is a lot of momentum here. And I guess we're in Saudi Arabia here, and we talked about it. I've never seen a country in my life in which you have a leader, a plan, a vision, geography, financial resources, and expertise and access to brands. So what's happening here probably never happened in the world for the last 20 years. So we just want to be a participant, but you know who I am. I hate to be a spectator, so I want to be an actor of my own life. So I just want to participate, collaborate, and be useful. But go to Abu Dhabi, go to Dubai, go to Qatar. They're doing superbly well as well.
So what kind of deals might you be looking at here? I mean, in terms of the expansion into the kingdom.
I'm trying to convince everybody that we have to shift the mindset from targeting to traveler to target to locals. So I want the Accor hotels tomorrow to be really designed for the local community. Because if you seduce a Saudi in Saudi Arabia, the travelers will pick and choose your hotel because it's a buzzing destination. So just reshifting our own mindset. But here, I'm going to go from mid-scale to premium to resort. We are all over. I need to be stronger.
I'm going to drag you to rainy and cold Europe for a moment, just to get your view on the room rates that keep pushing higher. Is that sustainable, in light of the impact of a recession that is still very much rippling through the economy?
Well, I think France is going to be avoiding recession. I'm not an economist, but I guess we're so much of a subsidized country. When it goes very well, we don't go very well. When it goes very bad, we don't go very bad. So France should be out of recession. UK, unfortunately, might be. It's one of those things where we've been coping with minus 80% occupancy for 2.5 years. Every time there's a recession in the world, -3, -4, RevPAR goes almost to the same indexes, which is -3, -4. I can tell you, we can cope super well with a -3% activity when you've been going through -80%. So I don't wish for it, but we will adapt for it in a much better manner than we ever did in 2008, 2009.
The variable that all of us have had to deal with is inflation, and now you've got a bit of experience in handling inflation. In retrospect, what conclusion do you take in terms of implications for room rates and occupancy rates? What has the impact been?
Well, the impact of it, we've done the mathematics for Accor. If we increase our own price per room by 5%, that means we can actually afford probably a 7 to 8% recession on energy and on payroll. So it's only 5%. Can I meet 5% uplift in 2023? I think I am. By the same token, you know, we are hotel operators. We don't own the assets anymore. So I have to admit most of the burden is on the asset owners as opposed to the hotel operators. So, but I'm not going to be blind about it. I'm trying to cope with it with my own owners, but it's less of my problem than some of my asset owners' problem. But again, in hindsight, Accor has a huge procurement activity. We do 5 billion of buying. We've been buying energy for 60% of the network up to 2024. So they would not see any energy inflation because of what we've been basically pre-buying a year and a half ago.
Seb, you're going through a reorganization internally. I'm wondering to what extent there's room for further job cuts as part of that reorganization, given the reality that you're seeing in the economy, no?
Youssef, I'm missing 40,000 people within my 280,000 people organization. So don't even think about a job cut. I need people back at Accor. That reorganization is only trying to have better expertise, more focus in the right segment. So we're splitting Accor in 2 autonomous divisions, Eco, mid-scale, premium, and 1 on luxury lifestyle. It happens to be different segments, different owners, different clients. And I was dumb not to have done it earlier. Probably did not do it because I didn't have the skill, ability to do it, but it's indispensable, and it's live on the 1st of January. And sense of ownership from my executive team is far better than I ever expected myself. It's going to work extremely well, but you will not be at any job expense.
Sebastian, always a fan of our conversations, very candid discussions. Thanks again for your time. That's Sebastian Bazin, the CEO and chairman of Accor, joining us here at the WTTC in Riyadh.
Youssef, thanks so much. Youssef Gamaldin at the World Travel and Tourism Global Summit in Riyadh, there with the Accor chief executive. Now, coming up, we speak to the man tipped to be the next deputy leader of South Africa's governing African National Congress. Paul Mashatile joins us next after the break. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. EasyJet says enduring demand for discounted flights should allow it to return to pre-pandemic levels of capacity by next summer. That's as the UK-based budget airline narrowed its headline pre-tax loss for the year to the end of September to £178 million.
Coming into this year with a record bounce back, it's a £1 billion bounce back that we did, and we achieved also the highest earnings ever in the last quarter in the company's history. So what we're seeing now for this winter going forward is that the peak periods are doing really well.
Crypto lender BlockFi has filed for bankruptcy, becoming the latest digital asset fund to collapse in the wake of the FTX fiasco. BlockFi says it will use the Chapter 11 process to focus on recovering all obligations owed to BlockFi by its counterparties, including FTX. The firm has asked clients to refrain from depositing more funds. A fight seems to be brewing between Twitter and Apple after Elon Musk accused the iPhone maker of threatening to keep the social network off the App Store. Musk also says Apple has cut advertising on Twitter, which he acquired last month. Apple has been one of Twitter's top advertisers, with a spend said to be above $100 million a year. That's the Bloomberg Business Flash. Francine.
Laura, thanks so much. Now let's turn to South Africa. The economy is likely to have averted a technical recession in the third quarter, despite record power outages. Now, reviving a struggling economy and dealing with embattled state-owned power utility Eskom will be, of course, key issues as a ruling African National Congress party's leadership race kicks off next month. Now, the ANC is battling to rebuild support after its vote dipped below 50% for the first time ever in a municipal election last year. Now, this comes as the party looks to protect its majority in 2024's general election. Well, joining us now is Paul Mashatile, Treasurer General for the South Africans ruling African National Congress. Mr. Mashatile, thank you so much for joining us. Now, the governing ANC will also hold its elective conference next month. It's no secret that the party has been dogged by some internal fighting or internal divisions. Have those been addressed? How are you expecting the Congress to go?
Well, of course, it's going to be a very challenging period for us. We are going into this conference prioritizing the unity of our members, all our structures. And that's why the theme of conference is unity and renewal. We want to come out of that conference very strong, united, so that we can tackle the challenges that the country is facing. As you have been saying just now, that we have the challenges with our state-owned enterprises, particularly the likes of Eskom, which leads to challenges like load shedding. So yes, serious challenges, and it will need a leadership that is united, the leadership that can pull together.
Mr. Mashatile, you've also received the most nominations for the post of deputy president. What kind of things are you promising in terms of energy, in terms of unemployment, in terms of inflation?
Well, I think the important thing is to get the economy right and get it right faster. The ANC has got a lot of good policies. So our focus should really be on implementation. I think we need to make sure that we implement much faster, because if we get the economy right, we can create employment, particularly amongst young people. So it will need that we sort out challenges of Eskom, look at other state-owned enterprises like your Transnet, PRASA. We're going to be putting a lot of resources to drive infrastructure development.
There was a lot of promises at the conference 5 years ago, nationalizing the central bank, establishing a state bank, and a change to the constitution to make it easier to seize land without compensation. None of those have happened. Are they still on the agenda?
Indeed, as you say, the conference in 2017, the 54th National Conference, did take a decision to nationalize the central bank. There were challenges in government, and that was not really done. So you might find that the debate will come back. My view is that we should allow the debate to take place, but we we should emphasize the fact that we do want a central bank which will continue with its independence as guaranteed by the Constitution.
Do you see the ANC retaining its majority into the 2024 election? And actually, you know, simply put, what can you do better to make the lives of all South Africans easier in the future?
Yes, the ANC at the moment is strong enough to retain its majority come 2024 elections. We're working well with our alliance structures and our structures on the ground. So we're going into that election to win decisively, and that's where we're putting all our efforts.
But there are some key metrics where South Africa has gone backwards in terms of hitting those metrics. I'm talking about, you know, the poverty line, people who are unemployed and below the poverty line. So specifically, what can you put in place to make sure that the most vulnerable are protected?
Well, as you know, that we have approved at the government level some relief mechanisms, some grants. But also, I think it's important that we put all efforts to drive economic growth and have a public service that is geared towards service delivery. That's why government has introduced a new mechanism to ensure that there's a new national framework on public service with people who are well-trained, who are skilled, to be able to deliver efficiently.
Mr. Mashatile, when you look at some of the things that, you know, we focus on, and you do believe that the ANC will win an outright majority, if it doesn't, who are you ready to be in coalition with in 2024?
Well, we have decided that we should focus on winning the election because for us it's important. We think coalitions are a problem. If we look at what's happening in local government at the moment, a lot of instability. We will cross the bridge when we come to it if we are in that situation where we need to consider coalition. But for now, we're fighting to win.
How much of a problem is dollar strength?
How much of a problem is?
Is a strong dollar given for emerging markets in general, but for South Africa in particular?
Well, as I said, as the ANC at the moment, we are trying to fix our economy, fix what's happening in government. We're going to focus on implementation. And come next year, we're starting our campaign to win the general election and win it decisively. So for now, we're really not entertaining coalitions, so to speak.
All right, thank you so much, Paul Mashatile, Treasurer General of the African National Congress, joining us this morning. Now, coming up, as Russia continues to target Ukraine's vital infrastructure, we're live from Bucharest, where NATO foreign ministers are gathered to discuss developments in the war. That's coming up next, and this is Bloomberg.
When I started, I had no idea it was going to turn into this. Just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, NATO foreign ministers are gathering in Bucharest for an extraordinary meeting as Russia intensifies attacks on Ukraine's energy infrastructure, plunging the country into darkness and freezing temperatures. Now, for more, we go to our Maria Tadeo, our European correspondent, who is in Bucharest. Maria, what exactly is topping the agenda?
Yes, Francine, well, a lot on the agenda, but also the significance of this moment and this location in particular, because Francine, I'm sure you remember back in 2008, the Bucharest NATO meeting, that was the first time the Ukraine membership to NATO was put on the table. And of course, we know the story. More than 10 years later, there's no membership for Ukraine, and there's now a full-scale war going on in the country. Now, today already we heard from the NATO Secretary General, Francine, who says there needs to be a comprehensive package for Ukraine. He's pleading allies for this package, which of course includes military equipment, but he says there needs also other issues like fuel, medical supplies, but also, and he really emphasized this point, winter equipment that can help the country. He says Ukraine is, quote, facing now a horrific winter. We know their energy infrastructure has been severely compromised. The country is in darkness. And of course, you're starting to see now temperatures go below zero, a terrible winter, of course, for the civilian population in Ukraine.
So, Maria, what about China? China's also going to be debated.
Yes, Francine, and I'm happy you mentioned and stressed that point, because the Secretary General today, in some of the briefing comments that he made, still highlighted and reiterated NATO needs to be alert and aware about the issues when it comes to security in China. And remember, it's no coincidence this year NATO changed its definition of China, which is now, quote, a challenge to the NATO security alliance. He says this is not a threat to China, it's just an obvious manifestation that China is a competitor when it comes to cybersecurity. He also says Chinese companies have been trying to really bid into the European market of critical infrastructure. He also mentioned 5G and repeated NATO members have to be extremely alert when it comes to China.
Thank you so much, our Maria Tadeo. They're covering NATO's meeting today in Bucharest for us. Now, the other story on the corporate side is, of course, what's happening with Juventus. Juventus dropping in today's trading session. I think we have a board that we can actually put up to look at what exactly it's been doing. It was down some 10%, then down 4%, now down 2%. Now, the story there is allegations of wrongdoing. We know that we need to wait for the investigation. We know that not only the chairman, but the whole board actually resigned. Juventus plunged into crisis after the chairman and the entire board resigned into alleged wrongdoing related to the company's lost 3-year financial filings. Now, this is a pretty dramatic exit. It follows an investigation by the Public Prosecutor's Office in Turin, but also an investigation by Consob into these market regulator into some of the football clubs' recent financial balance sheets regarding alleged false accounting and market manipulation. The club has denied any wrongdoing. European stocks overall open higher. They continue the push higher as nationwide unrest in China over COVID curbs eased. That's boosting sentiment for riskier assets. The other thing we need to watch out for, and I'm looking at euro dollar, but a lot of the movement is actually on European yields, is that Spanish inflation eased for a 4th month and by more than expected. That is reinforcing expectations for a wider slowdown in European prices, and it could also offer some comfort to the government, whose aid measures have brought record budget spending. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kaylee Lyons in New York, our Anna Edwards here in London, and this is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's start with the idea of getting control over inflation.
And as long as inflation stays elevated, it just makes the case to me we need to do more.
They're counting the first 250 basis points as if that was a tightening of monetary policy, and we're going to have to move farther.
It will take some time, but I'm fully confident that we'll return to a sustained period of price development.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Fed makes it clear more rate hikes are on the way. Policymakers stress that borrowing costs must rise in the fight against inflation. China clamps down. Beijing responds to widespread protests by putting more police on the streets and censoring social media. We have news on COVID. And Elon Musk picks a fight with one of Twitter's top advertisers. He's asking whether Apple hates free speech and criticizes its app fees. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And clearly a focus on the Fed narrative, a focus on tech majors such as Twitter and Apple, Kaylee. But from a market perspective, we had been pretty obsessed with what was going on with China over the last 12 hours or so. That has faded a little bit, though, that China COVID boost in European markets.
Yeah, well, we have definitely seen a big boost in the Asian session, even if it is fading in Western markets, Anna, because all of that unrest and the protests around COVID lockdown seem to have calmed down, in part because of the government response and a heavy police presence, which was aimed at cracking down on that. But you also seem to have concessions from Beijing. They're going to up vaccinations for people 80 and over, plus maybe reduce some of those testing requirements. So all of that together lifting risk sentiment in Asian markets, specifically for Chinese stocks. The Hang Seng China Enterprise Index up more than 6% overnight, and an even bigger move for technology stocks, with the tech index up about 7.7%. And that's rippling through to foreign exchange as well. The offshore Chinese yuan, one of the biggest outperformers against the dollar among Asian currencies, strengthening by nearly a full percentage point. Just shy of 718 is where we trade. And I wanted to point out the Chinese 10-year yield as well, up 3 basis points overnight to 290. We started the month of November at 266. So this has been a pretty sizable move. And that 10-year yield is now actually at its highest in about a year, Matt.
All right, we're looking at drops here as well in terms of yields, and really the dollar. I think that's the most interesting thing here. S&P futures up about 0.2%. So Anna, you're right. We have faded the gains that we saw earlier on hopes of China reopening, at least sooner than previously had been thought, but still looking at gains. And I think that's because we are losing the headwind of a strong dollar. In fact, a lot of people, JP Morgan is one of the banks out there saying maybe the dollar run is over here and we could start seeing new lows. That's why we see gains in European currencies. We saw that yesterday as well as today. NYMEX crude is up 2% right now, but only to 78.84 a barrel. So a little bit of gain after the drop that we saw yesterday morning or Sunday night. We were looking at a 73 handle. So it's actually a pretty big jump from there. And then Bitcoin right now about 2% as well. Still holding around 16,500 right now, 16,517. So not a heck of a lot of movement there. What do you see in terms of the European fade today, Anna?
Yeah, so we were looking at gains, Matt, across this European map of around 0.5% for some of the major markets, but those have faded, certainly in France and in Germany. The German market now down by around 0.2%. We cling to the gains in London, and London is up by 0.6%. You'll see that is really to do with energy and energy markets, energy prices. It's to do with energy stocks, and it's also to do with mining stocks. I'll show you where we are on those particular stories. We have Brent crude, of course, bouncing back from yesterday's losses. So whilst we've overall seemed to have shaken off some of the enthusiasm around the China reopening story, more on that in a moment, it does seem as if certain sectors are clinging to that theme, and energy markets is one of those. 85.15 on Brent. Lost substantial ground yesterday as a result of concerns around China protests, now gaining this morning on expectations that perhaps there'll be some further reopening of the Chinese economy, and that is positive for crude. Basic resource stocks also helping out the London market, then up by 2% this morning. And here's the Italian 5-year yield. We've got yields coming down across Europe, and this is across the Eurozone. This seems to be quite a convincing move in today's session, particularly at the short end of the curve. It wasn't Italian data we got today, it was Spanish data. We just got one building block of the Eurozone inflation picture, but a lot of people asking, are we going to see a peak soon? Christine Lagarde saying she'd be surprised if we have peaked. It was the Spanish-Italian number, and it came in substantially below estimates. I put in the Italian market, though, because this is where we're seeing, of the G20, this is where we're seeing the biggest, most unusual outside move in markets, but that's where we yield right now for Italian 5-year debt. And keeping it Italian, this is a football club, a soccer club based in Turin. Torino in Turin in northern Italy, and the stock is down by just over 3%. The Juventus chairman and the whole of the board stepping down. Some controversy around the way that players have been valued in balance sheets. It seems that there's now an investigation going on into the last 3 years of financial filings for this business. The company denies any wrongdoing, Matt.
All right, well, we'll keep up with that story for sure. But main focus, I think, is going to be on the Fed. We got a host of Fed speak yesterday with policymakers stressing they will raise borrowing costs further to curb inflation.
Inflation's been stubborner than I would like.
Further tightening monetary policy should help restore balance between demand and supply and bring inflation back to 2% over the next few years.
They will come down, I think. That's my baseline, but they probably won't come down quite as fast as markets would like.
Very supportive of a path that is slower, probably longer, and potentially higher than where we were.
Only recently moved into restrictive territory, and we're going to have to move farther in order to keep inflation under control.
Of course, tomorrow we're going to hear from Jerome Powell. So this is a very Fed-focused week. Bloomberg's Danny Berger joins us now to break down the details of what to expect. Danny?
Yeah, Matt, it really feels like this last mile, this last push from the Fed before the blackout period begins, and I should say a hawkish push from them, which isn't necessarily surprising given financial conditions have loosened, stocks have rallied, treasuries have been bid. So maybe they want to undo some of that to keep inflation in check. I want to just pause on what Bullard said. We heard from him there just a moment ago. But he was saying yesterday that markets are underpricing the risk that they're going to get more aggressive and stay there, and said that the Fed needs to move to at least 5%. The market is going to have to do some repricing if it's going to factor that in. And you get Williams following up on that as well yesterday, saying that the path of inflation suggests that they will go higher. So what we have seen is a yield curve that continues to flatten, but it's been bullish flattening. In other words, it's been a bid into the long end. The front end hasn't really done much. Folks seem confident that we've reached cycle highs for the 10-year, for the 30-year. PIMCO, for example, is buying over there. But that 2-year yield has essentially sleepwalked. So yesterday, we got a cycle low of about negative 81 basis points in the 2s, 10s yield curve. 2s are at 4.4%. If they're going to get to that 5% that Bullard was talking about, Anna, they might have some readjusting to do leading up to this next Fed decision.
Okay, but still a little way to go until we get there. Danny, thank you very much. Bloomberg's Danny Berger, building our way towards the last Fed meeting of the year. Now, in China, authorities have clamped down on protests against tough COVID restrictions with a heavy police presence in major cities. Meanwhile, the country plans to ramp up vaccinations for senior citizens, a move regarded by health experts as crucial to removing tough COVID zero curves. China's National Health Commission spokesman spoke earlier.
We must correct the wrongful practices of arbitrary imposition of restrictions and provide services to people to meet their needs. We also advocate rapid and active vaccination, particularly the elder population, so as to protect yourself and your family.
Rebecca Chung-Wilkins joins us now, Bloomberg Asia government and politics correspondent from Hong Kong. Rebecca, it did seem as if you could draw a line between the protest activity and this commitment from health officials to hold accountable any local policymaker who's too sort of overzealous in their application of the COVID rules. So, maybe that's a win for the protesters. A lot of focus also on the vaccination rate and driving that up amongst senior citizens.
It does seem like we have seen quite a significant softening in tone from Chinese health authorities in particular, perhaps acknowledging in their own way, and at least, the very least, acknowledging there is a need to respond to what they've said as the reasonable requests to tweak policy around COVID. Over the last few days, we've also continuously been hearing that sort of Chinese authorities are always constantly adjusting policies, again, sort of just opening the door up for potentially going forward with loosening policies here. And as you say, investors and markets very happy to see signs that China is going to be vaccinating and focusing on vaccinating its elderly population. That seemed to be a very sort of weak point in its vaccination program that they will have to do if they want to reopen. At the moment, only about 40% of China's over 80 population has received their booster.
Well, Rebecca's saying markets look happy with some of this almost seems like an understatement, because we saw massive moves in Chinese equities overnight. How overdone does that seem?
Well, it's part of a really big reopening trade that just before the protests took off were roaring through Chinese assets, both in Hong Kong and in the mainland as well. There is a very sort of big bet that many people are taking that there will be significant reopening going into 2023, so the end of the first quarter, certainly going on into the second quarter. It really ultimately, I think, though, depends on whether or not China can roll out an effective vaccine program. And, of course, a lot of this is going to be decided by local governments. Central governments, of course, set the tone, but it's local governments who will have to take on the responsibility of potentially loosening things too early, and then having to deal with the consequences and the pressures on their healthcare systems, for example. So there is both this issue of the central government setting policy, but also implementation, even once that comes through. And we are seeing now these sort of big spikes in cases across China. It's not like back in April where we saw really most of the cases in Shanghai. Beijing, Guangzhou, Chongqing, these are big centers where cases really are rising in earnest now.
Yes, just getting some headlines across the Bloomberg. Rebecca saying Beijing reports, earlier saying that they'd reported a number of COVID cases and saying that 23 makeshift COVID hospitals are in use. Things are changing fast, it seems, in China. Rebecca Chung-Wilkins joining us there with the latest news on the COVID fight. Let us get to some news from the tech sector coming to us overnight. Billionaire Elon Musk is publicly attacking Apple in a battle that pits the owner of Twitter against one of the company's top advertisers. Musk says that Apple has cut its Twitter advertising and threatened to block the social network from its app store. For more, let's speak now to Bloomberg's Giles Turner, who joins me on set here in London. Good morning to you, Giles. So explain how we've got to this point.
Well, I mean, everyone loves a Twitter fight, first of all. I mean, we've got the world's richest...
Even when it involves Twitter.
Exactly. I mean, we've got the world's richest person against the world's biggest company, so, you know, I think it's going to be pretty epic, and we get to how epic in a bit. But really, this is about Twitter making money, right? They want to charge everyone $8 for using Twitter. If you're going to charge that money, then Apple's going to get 30% of that. So $2.04, I think. So he doesn't want to have that because he needs to make money. Twitter has made money for a long time. I mean, he makes plenty of revenue, but not much profit, right? Or hardly any. So he's got to solve this problem, and one way to do it is try and claw back some of that $2.04 for every user.
So, you know, we keep asking this question ever since Elon Musk took over or really kicked off his bid. What kind of risks does it have to Twitter's ability to operate at all?
Well, I think even if it gets banned, for example, let's go for worst case scenario, you and me can still use Twitter. You won't be getting any new users, but everyone else can still use it. There also is a way around it. You can still, the revenue problem that is, you can still avoid, Twitter can still avoid paying that $2.04 to Apple if you download it from their website, for example. But really, I think it's a great opportunity for Musk to have a fight with the regulators on his side for once. We've been talking a lot about how he's had plenty of issues with regulators, especially around safety, because obviously he slashed the workforce by 50%. But regulators and lawmakers, both in Europe and the US, they really don't like the fact that Apple charges this 30%. It's a gatekeeper problem, and they don't really want that, they don't want it to happen. Now, they had a huge fight, Apple and Epic Games, the company behind Fortnite back in 2019 that lasted for a few years, about this 30% problem, and Apple won, right? Maybe on a technicality, but they still won. They can still charge 30%, right? We might see this fight happen all over again, and maybe the result will be different.
Right. I mean, charging 30%, it should be said, on the App Store that they invented to put an app on the phone that they also produce. So it's interesting to say the least. Giles, thanks so much for joining us. Bloomberg's Giles Turner talking to us about Twitter v. Apple. In other TMT news, Disney's returning CEO Bob Iger has told employees at a company town hall that he'll look into some of his predecessors' more controversial decisions. One of those is requiring reservations for guests attending theme parks. Iger also said he'll focus on profitability in streaming and shot down a rumor about a possible merger between Disney and Apple, calling it pure speculation.
All right, Matt, and Disney shares right now up about 0.4% in pre-market trading. So let's take a look at some stocks moving to a larger degree in pre-market here in the U.S. And a lot of them are in the energy sector. Of course, these stocks were under some of the most pressure in the selling of yesterday, but they are rebounding this morning as we see oil moving higher. Halliburton, ConocoPhillips, Occidental Petroleum, all up in the ballpark of 1.5 to 2.8%. Another group of stocks that is moving higher is those Chinese technology companies that have listings here in the U.S., really following on the rally we saw saw in the Asian session overnight. Alibaba, Baidu, JD.com, all higher to the tune of 5.6 and even 7.25% in the case of JD. One stock moving to the downside, though, is Roku. This is after an analyst at KeyBank cut his rating on the stock, saying that the consensus is too optimistic for both 2023 and 2024. And as a result, Roku shares down about 2.6% before the bell, Anna.
Okay, we'll keep an eye on that one. Coming up on the program, we'll discuss the economic impact of the unrest in China and the policy response around COVID-19 that we've heard overnight from Chinese authorities. Diana Choileva joins us, Inodo Economics chief economist. And on the markets, Sharon Bell, Goldman Sachs European equity strategist, joins us. What does she make of the latest inflation data out of Europe? A question we'll also put to Irene Tinagli, who is the chair of the European Parliament's Committee on Economic and Monetary Affairs. She was hearing this week from Christine Lagarde. What does she make of the testimony of the president of the ECB? We'll get to that conversation and talk crypto with her as well. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Let's get back, though, to China right now. Health officials are sounding a conciliatory tone a day after police blocked more protests against the COVID restrictions there. They said excessive curbs should be avoided and questions about how COVID is being handled should be resolved quickly. Joining us now is Diana Choileva, chief economist at Inodo Economics. And Diana, you know, yesterday it seemed as if the protests would only strengthen the resolve of the party to lock down the country in the face of COVID. Now it looks like they're offering a bit of an olive branch. How do you see it?
I see this as the most minute olive branch, really, and market optimism seems misplaced at this stage. The Chinese authorities' first reaction was to make sure that they ramp up their propaganda apparatus and clamp down on social media and the dissemination of information, but as well as that on the protest, as you said. And they seem to have the upper hand. In the system that China has, it's extremely difficult for these protests to gain momentum. The levels of control and the use of technology in achieving it are pretty extraordinary.
Diana, why is the party, why is Xi Jinping so intent on this incredibly draconian COVID zero policy rather than, using vaccines that work from the West or letting the disease run its course?
He's in a difficult position, really, really tight spot. And actually, the protests are making his situation worse because he would have been much more willing to relax the zero COVID policy more substantially on the basis of the economy underperforming and really struggling. The problem he faces now is that these protests are linking the lockdowns with a more generalized pushback against increased authoritarianism in China, which really the COVID lockdowns brought down to the everyday life of the Chinese in a way that they haven't had. So now that there is this linkage and the protests are directly against the very top rather than the local governments, she's actually facing an even worse dilemma of how to exit from the zero COVID strategy without losing face. And if you get Western vaccines or you change dramatically your policy and start accepting significant deaths that they will have to have, then that is really untenable from a political perspective.
Can I ask you, as an economist then, Diana, what kind of assessment do you make as to how long it will take China to open up? If you think about the things that will be important here, the vaccination rate, the number of ICU beds that are available, and the death rates that China is prepared to tolerate from this, how long does it take to China to lift all of the COVID rules?
Look, China is in a kind of a slow motion real economy crisis. Clearly, they're ramping up monetary stimulus and debt-fueled investment, but that's really hitting against not just the lockdown dislocations and disruptions and the devastating impact that these lockdowns have on consumer spending, but also actually on the fact that China really is over-indebted and can't afford this debt-fueled growth for much longer. It certainly is going to get a lot less bang for its buck. So the economy is in a really tough spot, and she doesn't have a clear-cut exit strategy. And any exit strategy will involve continued economic pain. So this is a situation that I think the way markets are reacting today, it's very surprising, given that what the Chinese came up with this overnight was a lot, one could argue, even weaker than the 20-point relaxation that they had earlier, which we also described as just tweaking.
Well, we are continuing to get headlines out, Diana, from China. Beijing's Chaoyang district says that elderly and kids can skip daily COVID tests, so maybe some degree of relaxation there. We've talked a lot about kind of the near to medium term impact on the Chinese economy, but I'm wondering about longer term effects. How much damage has been done to China's reputation as a place for companies not based there to produce their goods, like Apple, for example, is the one that comes to mind, or really just as a partner in trade? That seems much longer lasting as companies look to reshore.
Well, this is part of the general great decoupling theme that has been our key investment theme over the last 3 years, the bifurcation of the world into two spheres of influence, a US and a China one. And COVID and China's response to COVID has exacerbated that split. And actually what China is doing right now is damaging its reputation as a reliable trading partner, which is adding to the geopolitical concerns that are causing reshoring and the great decoupling.
And there's a huge question about what that means for the growth and inflation trajectory in the global economy. Diana, we have to leave it there, but thank you so much for joining us with your insight. That's Diana Chwaileva of Inodo Economics. Now, keeping you up to date with other news from around the world, let's get the first word. A bill in the U.S. Senate protecting same-sex marriage has cleared another procedural hurdle. A vote on final passage could take place this afternoon. If it passes, the measure then goes to the House. The bill would recognize same-sex marriages under federal law and ensure benefits for all married couples. Former Vice President Mike Pence is calling on Donald Trump to apologize for having dinner with a white nationalist. In a TV interview, Pence said the former president showed profoundly poor judgment. Last week, he dined at his Mar-a-Lago resort with rapper Ye and white supremacist Nick Fuentes. President Biden and House Speaker Nancy Pelosi are moving to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor settlement despite the objections of some unions. A rail strike could hurt the economy by crippling supply chains. And BlockFi has become the latest crypto firm to collapse in the wake of the downfall of FTX. The digital asset lender says it will use the Chapter 11 process to recover everything it is owed by its counterparties, including FTX. But BlockFi acknowledged that recoveries are likely to be delayed by FTX's own bankruptcy. So, Matt, another domino has fallen. It's one we all were largely expecting to fall, considering BlockFi already had its issues, got bailed out by FTX, then FTX itself needed a bailout. The question is, what's the next shoe to drop? We're still looking to see if Celsius got the funding it said it needed.
Yeah, absolutely. And I think the BlockFi
Genesis,
shoe,
rather.
The BlockFi shoe was already had already dropped. I think it'll be very interesting, you're right, to watch what happens with Genesis and Gemini. I think that's what a lot of market participants are kind of holding their breath for. BlockFi seemed beyond saving, the other two not so much, Anna.
Yeah, absolutely. And we'll get to the regulation conversation on this. We talked about this yesterday, didn't we? Talk about the sort of regulatory arbitrage in different parts of the world, and certainly the Europeans plowing ahead with regulation, the MiCA framework. Do we need a MiCA 2? Christine Lagarde was talking about that just yesterday. Before we get to that conversation, we will talk to Sharon Bell, Goldman Sachs European equity strategist. What does she make of the London market right now? It outperforms on days like today when we see energy and mining stocks jump. Is that enough to get in and buy that market, or do we need further confidence in the UK infrastructure and the UK markets more broadly? We'll have that conversation shortly. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed makes it clear more rate hikes are on the way. Policymakers stress that borrowing costs must rise in the fight against inflation. China is making some quiet concessions on COVID limits a day after police blocked more protests. Authorities are easing up on some restrictions and also pushing to bolster vaccination among its senior citizens. And Elon Musk picks a fight with one of Twitter's top advertisers. He's asking whether Apple hates free speech and criticizes its app fees. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, global markets, risk appetite was wobbling a little half an hour ago. I don't think it was anything we did, but it seems to have recovered slightly. It was pushed along overnight by the better news out of China, it seems.
Yeah, slightly better news, right? I liked how Diana Troileva put it earlier. She said it's a minute olive branch. You really have to squint to see those concessions, but as we know, the markets love to front run good news. They want to get it before everyone else does. So when it's not there, sometimes they kind of make it up. In any case, we're looking at S&P futures gaining about 1/3% right now. We did close down 1.5% yesterday in the cash trade, down below, back below 4,000. So we're trying to claw some of that back. The Bloomberg Dollar Index, which, you know, the strength a month ago or 2 months ago had been a real headwind for equities, has dissipated quite a bit, and it continues to come down with a number of banks saying they now think that their bullish bets should be reversed on the dollar. So you can see gains in the euro and other currencies against the greenback. Right now, 12.73 is the BBDXY. NYMEX crude coming up a bit, 2.7%. Maybe this is on reopening hopes for China, now up to 79.33. And remember, we saw a 73 handle early yesterday for WTI crude. So that's a substantial gain. And Bitcoin is up, but it's not terribly substantial, still hovering around the same $16,000 level we've seen ever since the implosion of FTX, right now trading at $16,499. Kaylee, what are you seeing in terms of pre-market movers this morning?
Well, Matt, it may not be a massive move for Bitcoin, but it's still enough to give a little bit of a lift to crypto-related equities like the exchange Coinbase, which is actually higher by about 2.3% in early hours this morning, recovering some of its 4% loss yesterday. That was in part spurred by the bankruptcy filing of BlockFi. Other stocks that are moving higher include most in the energy sector with the gains in oil that you were mentioning, Matt. Exxon is one of them, up about 1% in early hours. And then following on from the gains we saw in Asia, all of that optimism around the China news that you and Anna were just discussing, we are seeing that some of those Chinese tech stocks that also have listings here in the U.S. are gaining. The ADRs of Alibaba up about 5.8% and JD.com up about 7.5% before the bell, Anna.
We're seeing here in Europe, Kaylee, then, a bit of a bounce back from yesterday's losses for European equity markets. And this is all to do with China and the reopening trade there, getting people excited, rightly or not. So the stocks Europe 600 up by 0.3%. Brent crude is up by 2.9%. Again, bouncing because of that change in the China dynamic overnight. Basic resources, one of the sectors doing well in London, up by 2.4%. That and energy names help to cushion the London market from any downside on a day like today and helps the London market outperform. I've got the Italian 5-year yield here just to underscore what we're seeing on Italian debt markets today. We got the Spanish inflation number. The inflation number came in lower than had been expected, and so that has brought yields down across European markets. And this is a member of the G20 for you, just showing where we're seeing those yields coming down. But if you want to see the bigger moves, Spain, Portugal, the yields there certainly making some big moves lower as a result of changing expectations about how much hiking the ECB has to do. We get the full Eurozone inflation print tomorrow.
Well, Anna, let's continue the conversation about the European economy and how it translates into an equity thesis. Joining us now is Sharon Bell, Goldman Sachs European equity strategist. Sharon, your colleagues at Goldman put out a note related to the U.S. economy and markets yesterday, saying that essentially U.S. equities are not correctly pricing in the risk of a recession, which Goldman puts at about 39% probability in the next 12 months. They say equities are only reflecting about an 11% chance. What's the risk in Europe, and is that appropriately priced?
So I think the risk of recession in Europe is a lot higher. In fact, we think that would be our base case, that you see a recession. We think Europe is in recession really now in the fourth quarter, and that will probably last into the first couple of quarters of next year. So I think the risk of recession is very much higher in Europe. Europe doesn't have energy independence. We have very high inflation, even if it's starting to come down from these incredible high peak levels, and that's obviously causing a decline in real incomes. But European equities are much less expensive than US equities. So the PE for Europe is probably only about 11 or 12 times, whereas it's, say, 17 in the US. So I would argue that a little bit more of weaker growth is priced into Europe than the US. But in both cases, we worry that cyclicals have bounced a lot. There's a lot of enthusiasm priced generally into global equities, and we think that's a little bit overdone.
Okay, so maybe the economic growth story is more appropriately priced in. What about the earnings growth story? Are those expectations still too high?
In our view, yes, on both sides of the Atlantic here. In the US, we expect zero earnings growth for the S&P companies next year, which, given sort of the trend rates that we've seen in recent years, high single digits earnings growth has been quite typical for S&P 500 companies. Zero is going to feel pretty low. And that's really because margins are still coming down. Companies are facing higher costs, labor costs, material costs, etc. And it's going to be trickier to pass those on to households and consumers when growth is slowing and pretty weak. And in Europe, a very similar picture. We're expecting actually earnings to fall next year by about 8% in Europe. That reflects the kind of gloomier picture we have for European economic growth. And again, we think the consensus, which is still for a little bit of positive growth in Europe, is a bit too high. And the main difference between us and consensus is on margins. We think companies will face higher costs, and it'll be trickier to pass those on.
Sharon, good morning to you. What's the Goldman Sachs view on how substantially we should view the changes overnight from China on COVID zero? And I ask this, I know that your role in European equities, of course, will be watching this your team will be watching this very closely, because there are so many industrial businesses in Germany or luxury goods companies in France that have made so much money in China. So what is the take as to whether these are really micro moves? It's the thin end of the wedge. It's the start of something that really gains momentum in the spring and summer.
So, look, absolutely, China is really important for European companies. And although I sort of painted a gloomy picture for the European economy, we do think Europe is in recession at the moment. European businesses, particularly the large listed ones, are global. They make less than half of their money in Europe itself. And China in particular is a big portion of sales and trade. We sort of tot up the numbers and come up with about 10% China exposure for European companies, but it's probably even a little bit larger than that if you consider the interconnections with China globally go very, very deep. So China's recovery is really important, and a move away from the kind of rolling zero COVID policy that we've seen is important. We think that the moves so far are really incredibly small on that front, and it will take several more months. We probably won't see really a move away from zero COVID into perhaps the second quarter of next year. So the market is right to anticipate it, but perhaps again a little bit too early in doing so.
I saw some comments today, and thinking about your view on the FTSE 100 or the FTSE 250, Sharon, it's a day like today where we see outperformance in London because of exposure, of course, to mining, basic resource, energy stocks. I saw a comment from the Lloyds Banking Group CEO, Charlie Nunn, earlier, who says that global investors are nervous about investing in the UK. Does that come up in conversations about UK equities?
Absolutely, it does. People are pretty happy with the concept that FTSE 100 is not very exposed to the UK. About a quarter of FTSE 100 sales are domestic to the UK, meaning 3/4 outside the UK. Lots of dollar earnings there, lots of China earnings, lots of global growth, lots of resources and commodity companies, obviously linked to China, therefore, but linked to the global growth generally and growth in the US. There is a little bit more skepticism on mid-cap businesses because they tend to be a bit more domestic. They also tend to suffer at times where you've got higher costs and higher wages. They tend to find that more difficult to pass on to their customers. I do think there will be recovery in the UK as we go through 2023, but at the moment it is a difficult patch, and there is nervousness from global investors in investing in those kind of more domestic-focused companies in the UK.
Are there recession-proof sectors or companies that you like, Sharon?
I mean, companies don't tend to ever be totally 100% recession-proof, but I guess the businesses that tend to have the lowest beta to the economic problems, say in the UK, would be global companies, would be healthcare companies in particular, would be companies which have got businesses which make a lot of dollars. Things like commodity companies, mining companies, oil companies. They suffer with economic downturns globally, but bear in mind there's a lack of supply in most of those areas. So they are still seeing quite high prices. And then finally, one thing about this downturn is it's coming with higher interest rates. And higher interest rates is generally quite good for financials. So that's another area, perhaps of more resilience this cycle than has been typical.
You're speaking at the Goldman Sachs Resilient Business event at Oxford, and I wonder, especially small businesses, how resilient can they be?
So in some ways, I'm surprised at how optimistic and resilient the small businesses are. The conference that I've been attending and speaking at, it's great to meet smaller businesses. These are the people that are growing the economy. These are the entrepreneurs that are hiring, creating jobs, creating growth for the economy. So, and they absolutely are aware that from a kind of big macro top-down angles, things are pretty bad. We have inflation, we have a cost of living problem in the UK, we have very weak growth, we are probably in recession. But all those things also create opportunity as well, which they're looking for. And I think we call this conference resilience because we think businesses should be thinking more broadly about their resilience. We know there's a lot more volatility now. Given the scarcity of labor, given the scarcity of energy, given the scarcity of resources generally, it's going to be really important for businesses to be resilient.
Yeah, and resilient to higher interest rates. Sharon, thank you very much. Sharon Bell joining us there from Goldman Sachs. Thank you for your time. Coming up, we will talk to Irene Tinagli, who is the chair of the European Parliament's Committee on Economic and Monetary Affairs. She was hearing yesterday from Christine Lagarde of the ECB. What did she take away from that conversation? We'll talk about monetary policy, inflation, also crypto. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In this environment of high uncertainty and with complex shocks hitting the economy, the Governing Council decisions will continue to be data dependent and follow a meeting-by-meeting approach. How much further we need to go, how fast we need to get there, will be based on our updated outlook, on the persistence of the shocks, on the reaction of wages and inflation expectations, and on our assessment of the transmission of policy stance.
That was the ECB President Christine Lagarde, of course, speaking at a hearing before the European Parliament's Committee on Economic and Monetary Affairs just yesterday. Joining us now is the chair of that committee, Irene Tinagli. Very good to have you with us on the programme then, Irene. Thanks for joining us. So we heard there from Christine Lagarde talking about inflation and growth and the like. How concerned are you about the inflation picture in the euro area? Are you comforted at all by numbers out of Spain today, which came in weaker than expected? What's your view on inflation?
Well, the problem with inflation in the euro area compared, for instance, with the inflation in the United States is that we have, on one hand, a peculiar kind of inflation, which is mostly driven by energy prices that both directly and indirectly affect the inflation rates. And this is something that unfortunately cannot be changed easily by just hiking the interest rate. So we need to have more comprehensive measures. And so this is one of the issues. And the other problem that we do have is and we discussed yesterday in the hearing, many different inflation rates inside the European Union. So you have countries, we have divergences. We have countries that have inflation rates as high as 22%. And countries that have actually much lower, like in the range of 6 or 7%. So depending on the energy mix, depending on the measures that have been taken by the national member states, because we know that the response in these months has been very, different from state to state. So we need to be very careful in trying to have responses that take into account this heterogeneity and does not increase the divergences, but tries to have a more convergent path. So it is very complicated, but we are, scrutinizing and looking and monitoring what is going on very closely.
So I hear you, Irene, that there are different rates amongst the Eurozone countries. Are you concerned then that the ECB may be hiking rates into a recession?
This was some members of the parliament yesterday indeed were concerned a little bit about that because we know that we are walking on a fine line because the economy is slowing down considerably. So many members of the parliament ask questions about these. How are we sure, how can we find a balance, by fighting inflation with the traditional tools of monetary policy, which is the interest rate, but how do we make sure that this does not accelerate or aggravate the potential recession, considering that already the forecasts for growth for 2023 are close to zero in the European Union. So we have to be very, very careful. And I hope this is also part of the strategy of the European Central Bank when President Lagarde says we want to make decisions based on data. I hope that this data includes not only inflation but also the stability and the economic conditions and situations of the European Union. So all these data have to be taken into consideration when some decisions about the interest rates are made. So that's why I think that the Governing Council is deciding step by step and not giving forward guidance in this uncertain scenario.
I want to take you to crypto right now because you've got new rules in place. MiCA, M-I-C-A, is the acronym for the new EU crypto rules. How would, for example, FTX have fared under a MiCA regime? Would the blowup have been avoided?
Well, this is actually subject of debate, and we will discuss it exactly tomorrow because we are having a hearing, a public hearing, so everybody will be able to follow that in the Econ Committee of the Parliament. It's a hearing on the collapse of FTX and just trying to understand what happened, because we are still trying to understand and discover what really happened, and if the regulation, if the tools that we have negotiated just a few months ago and that we are about to vote in the plenary would have been sufficient, because they are still not in place. So the MiCA regulation is still not functioning. So we have negotiated it, we have approved it in the Econ Committee, and but now we have to go the final steps, and it will be in place later on. Would that set of that toolkit be enough to prevent cases like the FTX. We will discuss that tomorrow, and we will try to better understand what went wrong, because we need to make sure that things like this that don't happen again in the future.
So if in those discussions, Irena, you find that they may not have been enough to prevent an episode like this, do you think the end result could be even tighter regulation going forward?
Frankly, I don't think we are going to reopen what had been negotiated and approved and voted in the past year. But what I think is that, you know, when we talk about regulation, we always talk about ongoing process, especially when we are regulating emerging phenomena, new phenomena. We have to adopt a gradual approach, trying to regulate what we know about, avoiding the over-regulation or avoiding, you know, things that may not work. So we adopt a step-by-step approach again. So we did this regulation. I think it's a good toolkit. We will evaluate this also at the test of the new cases that are coming up in these weeks and the upcoming months. And we can always improve on that regulation as we normally do. So we normally do reviews or quick fixes. So regulations are not set in stone. We move forward when we believe that certain regulations need to be updated to address upcoming issues. So, but it will be, of course, not up to me, but up to the Parliament and up to the members of the Parliament and the political group to evaluate and decide how to proceed on the process of better regulating the crypto asset markets.
So clearly a lot of different players involved in these conversations, Irene, but do you personally view crypto as having some kind of more systemic threat to financial stability, given the episodes we have seen, being that FTX was not the first collapse wave we have seen this year?
Well, you know, it's still maybe early to, right now we are not seeing that systematic effect, but also because it's a relatively new phenomena. But we also see that it is, on one hand, it's been growing exponentially, so potentially could become a phenomena that might have a systemic effect in cases of collapse of certain platforms or service providers, etc., like the ones we are seeing in these weeks. So I think we need to be really careful in monitoring what is going on and trying to put in place regulation that would prevent that to blow up out of proportion and to become a systemic threat. So for once, we would like to act before the systemic, because, you know, in the past, we had to regulate after. For instance, during the great financial recession, we had to act and put regulations in place after the collapse and the recession. So we would like to prevent that. Of course, we would like to do that with all the information, with all the elements that we needed to have a proper regulation.
All right, so anticipating, not just reacting. Thank you so much for joining us, Irene Tinagli of the European Parliament's Committee on Economic and Monetary Affairs. We appreciate your time. And for more conversation on crypto regulation, tune into Bloomberg Crypto today at 1 p.m. New York time, 6 p.m. in London. It's our weekly show with Matt and I that shows the people, the transactions, and technology shaping the world of decentralized finance. We'll be hearing from crypto investor Aaron Brown and crypto skeptic John Reed Stark this episode. This is Bloomberg.
you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Let's take a look at what's ahead today. NATO foreign ministers have begun 2 days of meetings in Romania. We're also watching Germany for inflation data. That comes out at 7 a.m. Eastern our time. At 10 a.m., we'll get U.S. consumer confidence data for November, as well as BOE Governor Andrew Bailey speaking in the House of Lords. So that's it for Early Edition from me, Anna, and Kaylee. Bloomberg Surveillance is ahead with Lisa, John, and Tom. I think they're all here. We'll hear from former New York President Bill Dudley, among others. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Yield curve, the labor market, and risk assets are all saying very different things at the moment.
We're all subject to the data.
Inflation is what the Fed's going to focus on.
It's hard to see inflation pressures easing off completely.
I don't think we're going to see inflation neatly fitting back into this 2% box anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back tomorrow. Equity futures positive about 0.2%. The main event really in the last couple of days, Bramo, has been China and the events over the weekend. The protest and what Chinese authorities would do, back away from COVID-0 or not. It seems like there's going to be some kind of a vaccine drive in the world's second largest economy.
For older people, just like we were talking about yesterday, why don't they accelerate some of the vaccination programs for people who are over the age of 65? Because it's a significant proportion of the population, too. It's not like this is a small proportion. They're willing to do that, but they're also cracking down pretty harshly on some of these protests.
I've been confused by it over the last couple of years, never mind the last couple of months. We'll catch up with Enda Curran in Hong Kong a little bit later this morning. Got to talk about the data out of Europe, too. Softer CPI out of Spain.
Yeah.
We've had the regional stuff across Germany. So far, so good. Easing just a little bit. Maybe some good news for the Europeans this morning.
Correct, although why? The why is interesting. This is fuel and energy costs because they did not necessarily go up as much as people had previously expected. You do see some sort of input from the fact that it has been a warmer than expected winter. At what point does that make them vulnerable if there aren't other inputs that are also slowing?
ECB on December 15th, Federal Reserve December 14th. Colby Smith over at the FT caught up with Loretta Mester of the Cleveland Fed yesterday. This line from Loretta Mester, the cost of stopping too early are high. We want to be very diligent about this. You just wonder how much that weighs them down going into their decision in December.
Well, and this is Bill Dudley's point, too, and Bill Dudley, the former New York Fed president, joining us later in the show. How much are they concerned about the fact that if they let inflation get away from them, they end up with a situation where they've got to clamp down much harder, and they're not going to go to a 3% level, right? Like, that's sort of some of the speculation from the Adam Posens of the world. Why not let it float to 2.5% to 3% in terms of an inflation target? A lot of people pushing back and saying, we cannot do that because this is our mandate, and we could potentially really unmoor the economy.
So if you had a crystal ball, you'd want to know two things for next year. We've been talking about it. One is China, two is the Fed. And if you had a crystal ball, you'd come up with your outlook, and Bank of America seemingly have their crystal ball, and they've come up with their outlook. Savita Subramaniam, 4,000 on the S&P 500 year end, not this year, next year. 2023. Very interesting, very much in line with really what we're hearing from Morgan Stanley and Mike Wilson.
But that's what I was going to say. This is actually consensus that we're going to bump along to the same place that we're at right now, and it's going to be bumpy, but it's going to be really under the index. So you're going to see a lot of the shift and a lot of the friction. The crystal ball is interesting at a moment where there's so many variables. And what I find interesting is that crystal ball pushes back against the Fed and says, the Fed, we don't buy it. You can come out with all your hawkish prognostications. We're still going to price in hikes by the end of next year. We're still going to go with what we think because you're probably going to be wrong.
Rate cuts, and they're saying we're not going to get rate cuts. Futures right now on the S&P 500 positive 0.2%, up about 1/4%. No real drama here. In the bond market in Europe, big rally off the back of some of that CPI data. We'll talk about that a little bit later. A rally in sympathy in the Treasury market.
Symphony too many.
Early days, same thing. Yields are lower by 3 basis points on a 10-year right now, 364.97. In the FX market, some euro strength for you. Euro dollar positive by 0.4%. Lisa, euro dollar 103.85.
Yeah, what you talked about earlier about some of the inflation reads that we got out of Europe, really interesting to me. The fact that we got softer than expected in Spain. And then when you look at the granular ones over in Germany and the different regions, they point to a similar kind of trend. We get at ADM, Germany overall inflation for November. We're expecting it to tick down just a touch. That's Bloomberg Economics and sort of the average of analysts surveyed by Bloomberg. How much, though, is going to be comforting before you get a different message from an ECB that has the same fear that the Fed does, which is letting letting inflation get away and the underpinnings of it without clamping down harshly now. At 9 a.m., we get a host of housing data out of the U.S., including the S&P CoreLogic Case-Shiller 20-City Home Price Index for the month of September. How much do we see that acceleration of the decline in home prices? This, to me, is a leading indicator, and it also takes out some of the confidence of consumers and the buying power, especially for people who are middle income, and that's something people have been watching. And at 11:30 a.m., a news conference by NATO Secretary General Jens Stoltenberg. He has a meeting with Secretary of State Tony Blinken in the U.S. Yes, he's talking about Ukraine. They're doubling down on what's going to happen there, but expect China to be front and center, too. That's what a lot of people are saying.
Do you think the housing data needs a rebrand?
To
Just
what?
to rename whatever that data is?
You mean you don't like saying the S&P CoreLogic Case-Shiller 20-City Home Price Index?
No. Can we shorten it to something
What would you
else?
like to call it?
I don't know.
Home data.
We call it the Case-Shiller data if you want.
But there's like different sets of it.
Okay, we're going to solve this a little bit later. It's like the shoe debate. How much feedback did you get about the shoe debate yesterday?
I mean, I
Shoes
got
on,
some.
shoes off.
Did you get a lot of feedback?
Tons.
Really? And people were all with you, or are they basically pushing back and saying it's kind of...
Most of my friends on board.
You're threading a needle here, because you're basically saying you as an individual should respect what other people do, but you as a host should not impose your view aggressively, but you can judge later.
Correct.
Yeah, okay.
And if you're not up to speed with the debate from yesterday, you didn't miss anything. Tony Crescenti joins us now, portfolio manager and market strategist at PIMCO. Tony, wonderful to catch up with you, sir. I want to start with a number.
John, Lisa.
Negative 77 basis points on the yield curve in America, the 2-year versus the 10-year. And I want to understand from your perspective and the team at PIMCO. Tony, how much signal can you take away from that yield curve right now?
Well, there's a significant amount of signal in the yield curve. It's a reliable indicator, as you know. But that number you referenced, John, is similar to what's called the term premium, which is the difference between the future short-term interest rates and that long-term rate. Typically, there's a term premium in a long-term interest rate, meaning that an investor says it wants additional yield for stepping out on the yield curve because there is more risk in stepping out on the yield curve. But these days, and for a long time now, the last 6 years, especially the last decade, investors haven't demanded much in the way of a term premium. Is it related to the Fed? It could be. Think about it this way. We know that lots of shelves were cleaned out during the pandemic. We saw supply chain problems, some stuff missing. There's still stuff missing from the shelves in the sense that the Fed took a lot of bonds off the shelves, trillions of dollars worth. It's only putting a few back at a time. So that keeps the term premium suppressed. So there is a bit of a distortion in that sense, but markets clearly are deciding that there are risks, elevated risks toward recession next year.
And Tony, a lot of people are going into longer duration because they do see the proposition of growth over the longer term really coming down dramatically. We were talking yesterday with Brian Weinstein of Morgan Stanley, and he said he could see a 3.25% 10-year Treasury yield before this rally is over, and you could see that yield curve inversion going to negative 125 basis points. Do these potential outcomes seem probable to you?
It is possible. Tara is the new investment mantra, in fact. A lot of investors are talking about the idea that there are reasonable alternatives rather than the old Tina. Tina's exited. Tara's entered the building. Tina was that there is no alternative. Now that yields are up, there are. Now, think about it this way as well. The boomers are aging. 1957 was the biggest birth year last century, so this year is the biggest year for retirements in history. This wave lasts through 2030. Think of the boomer mentality in the 2010s. They probably thought they'd never, ever see interest income as part of the future earnings story, but now they do. And so they will keep pushing back, you could say, on these higher yields when they happen, because they'll say, well, thank goodness, now I can rely perhaps on interest income. Plus, there are numerous other reasons why investors might want fixed income, and so they could push into yields. What I'm trying to say is that there will be non-economic reasons in a sense, but it's economic, of course, if you're a retired individual, for wanting to explore fixed income today, because there are reasonable alternatives, and yields do look good relative to future inflation, relative to the long-term average, and as a hedge against future recession risk, because bonds do tend to outperform equities and credit in cases like that.
So what's your highest conviction move ahead of next year, especially given that people are already rewriting their 2023 outlooks?
The biggest area of conviction that one should have entering 2023, and it isn't easy, is to expect that interest rate volatility will plunge next year. relative to 2022, because the forecast miss on the federal funds rate is highly likely to be a lot smaller next year than it was this year. The Fed, others expected the funds rate to end at 1%. It's ending near 5%. What are the odds of a 4-point miss next year? What if it's 1 percentage point miss next year and the markets think it's a 6% funds rate instead of 5, where it's priced now? You'd see the type of repricing in markets that you saw most of this year, but it probably wouldn't go that far because it seems like between the 3 Fs, the Fed, fiscal policy, and financial conditions, it will be enough to cause meaningful disinflation, and that therefore lower interest rate volatility will benefit lots of assets, agency mortgage-backed securities for one, ultimately credit, ultimately equities, etc. But the real volatility might be in spreads in the bond market, not in interest rates.
Hey, Tony, can we get a forecast for Team USA today at the World Cup against Iran? You've got a number for us.
I'm a baseball player, so you're asking the wrong person, John. But
one of Tom Keen's
mates. Say go USA. I can only say I'm sitting in the United States.
I know, it's just ridiculous.
Citizen. Let's go with the United States.
It's not ridiculous. Tony, thank you.
Tony, thank you. Tony Crescenzi of PIMCO. It's one of Tom's mates.
No, can I just say, I love...
It's one of Tom's
You
mates.
did something today, and I want you to do it every day.
What's that? What would you want me to do?
You put out every morning a morning note on Twitter, and you put sort of top stories, and they typically...
And then the stuff I actually cared about.
And then you put out the stuff that you actually cared about, which Binotto quitting Ferrari. He is the Formula One.
Of the
yeah,
Ferrari
exactly.
Team, yeah.
Juve's board resigns.
Yep.
And the Group B final games.
Yeah,
and that's what you care about. Yeah, exactly. And so you're basically like, this is what I'm supposed to.
I'm still going to talk about.
This is what I'm
going
paid
to talk about
about.
market stuff. That's what I get paid to talk about, and I assume I get paid to talk about some sports stuff now and then as well.
Yeah, but yeah, and actually, I will say that in 4 years' time. In the U.S., I'm going to guess that more people will have cogent responses to you with respect to football games.
This is why I'm so bullish, Team USA. I want to see them do really, really well, because what's good for them is good for the sport. Honestly, I truly believe that. If we can have a really, really strong U.S. men's football team in the same way we have a really, really strong U.S. women's football team, I think it could be absolutely fantastic for the sport in 4 years' time when the World Cup is hosted in North America.
It's actually gaining so much traction, in part
great.
because parents don't want their kids playing traditional football. They want to play soccer.
No, the problem is, it's the boomers like Tony pushing the bonds, pushing the treasuries on people in retirement who still like baseball.
Oh my God! No. You took this a step too
cash,
far.
all of that stuff.
I like baseball too. You cannot undermine baseball.
It's the boomers.
Oh, Jesus!
You
had me,
the
and then
boom.
Buy
treasuries.
Yeah.
And blame Tom's generation.
Yeah, exactly. It's good that he's not here.
Everything. Evan Brown of UBS is coming up in the next hour. Looking forward to that. Live from New York. This is Bloomberg.
You lost me too, Jonathan. All right, keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers are stressing that more interest rate hikes are on the way to curb inflation. New York Fed President John Williams told reporters that he sees rates heading somewhat higher than he had forecast just a few months ago. Meanwhile, St. Louis Fed President James Bullard says that markets are underpricing the chance of higher rates. China plans to increase COVID vaccinations among its senior citizens. It's a step that health experts regard as crucial to reopening an economy stuck in harsh COVID-0 restrictions. Still, Beijing stopped short of announcing mandates that helped raise inoculation rates in other countries. The move comes after a weekend of protests demanding an end to COVID limits. British Prime Minister Rishi Sunak says the UK cannot rely on what he called simplistic Cold War rhetoric against China. In his first major foreign policy speech as premier, Sunak also said it would be naive to think that trade would lead to social and political reform. He said that China cannot be ignored, especially on issues such as global economic stability or climate change. And you'll have to wait a little bit longer for that new iPhone. COVID lockdowns and worker protests at Apple's key assembly plant in China have delivery times for the iPhone 14 Pro models in the U.S. as long as 37 days. That's according to Counterpoint Research. Apple is expected to face a shortfall of 6 million iPhone Pro units this year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Our message to peaceful protesters around the world is the same and consistent. People should be allowed the right to assemble and to peacefully protest policies or laws or dictates that they take issue with. We're watching this closely, as you might expect we would. And again, we continue to stand up and support the right of peaceful protest.
That was John Kirby, the White House National Security Council spokesperson, responding to the events in China over the weekend. Live from New York City this morning. Good morning. Equity futures just about positive, up 0.2% on the S&P 500. Chairman Powell speaking tomorrow on Wednesday. And then you get payrolls data on Friday. Yields are coming in a couple of basis points, down 2 basis points on a 10-year to 365.71. Here's a line from the President of the United States. He was speaking in the Rose Garden. Here's the quote. Good morning, everyone. As you might guess, I am very pleased to announce a tentative labour agreement that has been reached between the railway workers and the railway companies. This agreement is a big win for America and for both, in my view. You know when that was? That was September 15th, Bramo. September 15th. And the 12 unions, all 12 unions failed to sign up to that tentative agreement. We got a problem.
And how does this president deal with it? Because he is the president of unions. And this is interesting. So he comes out and he's asking Congress for help to force some sort of deal here because some of the unions won't sign on to this. How does he message this in a way where he still sounds pro-union, even though he is going above them and injecting Congress?
Anne-Marie is back in town, I'm pleased to say. AMH, welcome back down in Washington, D.C. Anne-Marie, walk us through what's happened here, why this is broken down, and what's on the table now.
Well, for the labor unions, it really comes down to this paid time off. They want this medical leave, and they say that's even more important than raise wages. So that's why you see one of the biggest labor unions, or the biggest labor union, voted this down. And that's really when tensions started to rise, and it looked like they wouldn't be able to get this agreement. They have till December 9th to try to negotiate this, but clearly that's just around the corner, and the White House doesn't look like that's happening. So now the president is out with a statement calling on Congress. Congress could be the ones to step in to avoid a strike. And what the president was trying to say yesterday in the statement, I'll bring you some of that. He is saying, let me be clear, a rail shutdown would devastate our economy. To Lisa's point, at the same time, he was saying, I am one of the most pro-union presidents we have in modern times, yet what he's concerned about is the havoc this would wreak on the U.S. economy, especially going into the holiday season.
What's the deal here going on behind the scenes? Why this wasn't signed onto by all of the unions, especially if freight rail companies are urging Congress to act quickly? Yes, we know this because the workers are the ones that are basically protesting. But on the flip side, there are some unions that also would like to see this agreement ratified.
There are some unions that already signed off on it, right? But you have to get all 13. And that's where the issue came down to. Not all of them were able to get all the votes needed from every single member is voting on this. So you have the top leaders negotiating at a table, and I met some of them that day in the Rose Garden and talking to them, and all the coffee and the sleep they were expected to need because they were working around the clock. But then members need to vote for this, and they see this as a moment in time where they can use this leverage right now. There are supply chain issues. We're going into Christmas, and there's a president that says he supports labor unions. So they feel like at this moment they could probably extract some of those demands, and for them that's going to be medical paid time off.
Anne-Marie, I'm glad that you mentioned the supply chain disruptions, because that is the broader backdrop for this. This president wants to see those supply chain disruptions ameliorated to alleviate some of the inflationary pressure. We're seeing that with the rails. We're seeing this over in China. How is the U.S. dovetailing their message with the Communist Party over in China in terms of wanting to end COVID-0 while also encouraging companies in the U.S. to diversify some of their supply chains away from just their reliance on that nation?
Well, you heard what Admiral Kirby says. He says they're watching these protests carefully. Quite a muted response from the White House. That statement about the fact that they support peaceful protests around the world could be said for a number of protests happening right now in countries. Iran as well comes to mind. But the fact that they're watching these protests in China carefully is all they've said, or closely, and they don't see an impact yet on supply chains. But of course, as you said, Lisa, behind the scenes, or even more so out front, the U.S. and the money they're putting into the United States in terms of semiconductor chip building, one, but also the rallying behind the business community in other countries around the world to divest away from China and to make sure that there are other supply chain routes, because that is what the pandemic really exposed, this reliance on China. Just similarly in Europe, it's reliance on Russian gas and oil, the fact that the West is too reliant on some of these countries. So it's an interesting moment right now in China, but the U.S., the administration hasn't come out and really said something direct or emphatic about these protests, just that they're watching them closely, but they don't see a hit to supply chains.
MH, how did some of this play out at the G20?
When it comes to supply chains, a lot of what the G20 cares about, what the United States cares about, is making sure they're shoring up these allies in places like India, et cetera, that they can have stronger supply chain outlets. And you do see some companies moving what potentially would have been a factory in China to a factory in India. The United States wants to make sure that they are there as a partner for some of these developing countries to be another lifeline instead of going through China, whether or not that's for debt sustainability and relief and working that out, or whether that comes to supply chain access.
Anne-Marie, great to have you back in a seat down in Washington, D.C. AMH there, back with us here at Bloomberg. Clearly, there's been a change in the labour market, a massive change. We were talking about the amount of leverage that employees had over the last 18 months. There seems to be a shift, and you can see that, I think, in the communication coming from a company like Snapchat. There's real tension now in tech across major companies. Don't know if you'd consider Snap a major company, but this line from Evan Spiegel about getting back to the office for 80% of the time, what each of us may sacrifice in terms of our individual convenience, I believe we will reap in terms of our collective success. Does that kind of communication, dare I say that cult-like stuff, really resonate with people anymore at tech firms. Given what you've seen take place at Meta, massive cuts, if you drink the Kool-Aid, does it make a difference?
Is it really getting through, or is it basically just saying, come back to work 4 days a week? This is what we need from you.
Sure.
If you don't, we're not going to have you still here.
Can we stop that collective success, individual convenience?
You could talk about HR speak and sort of the, kumbaya.
It's not HR speak. Do you know, it's like that Kool-Aid. Drink the Kool-Aid. You're part of more than just a company. Are people buying that anymore in Silicon Valley? Does that mean anything?
Will we see a complete culture shift? Because it's been a harsh reality after buying up and basically adding a ton of staff, putting ping pong tables in and having booze at 4 p.m. and yoga sessions. Look, I think that it's a well-taken point. The bigger picture here, Wall Street's been seeing this, and that they've been not saying it with the same kind of kombucha message, which is, we need you back in the office. We're much better with that.
The company fired 20% of the workforce.
But that's exactly it. I mean, they're firing the workforce, and then they're saying, we're still going to hold to this sort of, very touchy-feely kind of message.
Sit there year-end at the drinks and sing Kumbaya and how you've drunk the Kool-Aid and you think the culture's so important, we're family, and then all your mates get laid off.
Look, I hear you.
Give me a break.
I hear you. Will this be a big culture shift? But at the same time, it is a pivot point to come back to the office.
Do you know why I'd go back to the office? Job insecurity. Nothing.
But that's exactly it. But what they can't say that. Come back to the office, or we're going to fire you.
Because we're a family and we need to be together. Stop it. It's just positive 2/10
How do you really feel?
I'll tell you.
Evidently you will.
From New York.
You just did.
This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority.
Away from the opening bell, equity futures looking a little something like this on the S&P 500, positive 0.25%. On the Nasdaq 100, up 0.5%. Big day of losses yesterday, biggest one-day loss on the S&P going back to early November 9th to be precise. Treasuries yesterday, 2s versus 10s, negative 81 basis points at the lows, just unreal. You've got to go back to the 1980s, I believe, to see the curve that inverted. More inversion this morning, yields down by another 2 basis points on a 10-year, 365.71 rather, on a 10-year, on a 2-year, 442.99. There is a bid in the bond market over in Europe as well. Downside surprise for CPI in Spain. Likely to see the same thing from Germany in about 90 minutes from now. So look out for the single currency. Euro dollar shaping up as follows. Going into all of that, euro dollar 103.73. Brahma euro dollar positive, 0.33%.
Yeah, interesting to see how the dollar has really been the weakest player overnight and over the past couple of weeks. I want to bring you this. Stephen Major just put out his major bond letter where he puts out his outlook. First of all, he just said the early stages of this year's World Cup remind us that football is a funny old game, so we can just start there. But he also didn't try to project what's going to happen. It was a range of outcomes, and how much are we really going to see that as we look at such different kinds of scenarios, whether it's China, whether it's energy, whether it's what's going to happen in terms of supply chain disruptions.
How do you read that quickly? I just got the same note. The only thing I read was what the bond market can learn from the World Cup. Have you read that note that quickly?
Well, I was looking at the 5% yield scenario and that the 10-year yield could go to 5%. That seems unlikely, but it also seemed unlikely that Saudi Arabia would beat Argentina. And then you're looking down. Yeah, so he was talking about 3% being most likely and what the scenarios would be. What I find most interesting about this is his thinking process. He's always been so smart and spot on because he isn't necessarily saying this is what I think is going to happen. He's going to game out the potential scenarios and how that could play out and give you some sort of probability.
You know how you joked about me talking about what I actually want to talk about?
Yeah.
Do you think that's Steve writing about what he actually wants to talk about, which is the World Cup and maybe not the bond market?
It's literally every note that I've gotten is trying to draw analogies to the World Cup, which is what they're actually watching. And then they come up with a range of possibilities saying, we don't know what's going to happen in markets, so let's go back to
Big
soccer.
game a little bit later, 2 p.m. Eastern time.
US.
Look, you're going to watch that?
Yeah, I am.
Good, I love that.
I actually am into this.
Do you know how happy that makes me?
Oh, well, I actually am genuinely doing it. I'm not just doing it to make you happy.
I never do anything just to make me happy.
I really wouldn't. You know that, but that's okay.
Joanne Feeney wouldn't either. She joins us now, portfolio manager at Advisors Capital Management. Joanne, can we start with the tech names because they've been hammered this year? I'm thinking of Meta. I'm thinking of Amazon for that matter as well. When do you start to think about picking up the pieces here?
Oh, well, good morning, John, Lisa. Clearly the higher interest rates, has reduced valuations across the board for anything that has substantial growth in it. But also there's fear of that recession, earnings numbers coming down. You look at it relative to not just history, but what they have in front of them. And some of those tech companies are better positioned than others. They have bigger, deeper moats. They have stronger, more secular growth in their end markets. A company like Amazon, Microsoft, we like those because the internet is not going to stop growing. The use of data is only going to get larger, more pipes, more data handling, more analytics. And so these companies, we think, are still really well positioned. They've gotten a lot cheaper. And the growth outlook in front of them, 3 years, 5 years, 10 years, substantial growth ahead. And we think that, as interest rate increases start to peter out, not necessarily reverse, the headwinds that have caused those valuations to come down over the last year, those headwinds are going to evaporate. And eventually they're going to turn into tailwinds as rates do come down. And we don't know when that starts, but we do think that the headwinds now are really diminishing. And that makes it a particularly good time, potentially, to start building positions in these tech names. And if you're a long-term investor, I think you're going to be pretty happy after a few years if you get into those now.
Can we talk about them as a monolith, or is it really company by company?
Oh, definitely, Lisa, company by company. The moat that, say, an Amazon and a Microsoft have relative to, a Meta or a Netflix, I think is a lot deeper. The network effects are stronger, the growth ahead of them because of the need for more data, more analytics. I think it's just much stronger for an Amazon Web Services and a Microsoft and a Google Cloud than it would be for more consumer-oriented tech companies like Netflix, for example.
Well, Joanne, overnight, we've been really focused on what's been going on in China, and we've been trying to play out what that means for supply chains, the disruptions for the iPhone Pro, how much this really bleeds out into structural changes in terms of whether it's reshoring or just sort of moving some production away. As an investor, do you care, or is this just a short-term blip and you just assume that the geopolitical headwinds are going to resolve themselves?
Yeah, Lisa, no, you have to care. And I think clearly the risks have gone up for anything with a supply chain that's rooted in China. When we can see Apple making some changes, right? They're starting to position themselves to spread their manufacturing out across the world, India, Singapore, elsewhere, and other companies are doing the same. So in the meantime, right, you've seen these valuations come down because of that higher risk of the supply chain. China still poses a large risk, not just to companies like Apple, but much more broadly, because so much of the global economy's manufacturing takes place, at least in part, there. And so that's why people are so focused on what's happening with the zero COVID policy and the protests and when this all might ease up. So keeping an eye on China, keeping an eye on the Fed, I think really helps investors assess the risk and make sure they're diversified across it. If you're a retired person, you're income oriented, there are ways to avoid that kind of a risk and try to carry through this volatility with more income-oriented stocks.
We've had a year of massive rate hikes, that's for sure. We've also had a year where banks haven't really performed in line with that. JP Morgan year-to-date down 15%, Citigroup down more than 20%, Bank of America down 17 percentage points. Joanne, what's the thesis now around the banks, and what's the argument to buy the banks going into potentially a recession and with a yield curve this inverted?
Yeah, John, the banks, clearly are benefiting from those higher rates. On the other hand, their capital markets business, IPOs, M&A, and other places where they get fees, that part of the business is really suffering. And so that's why we've seen these valuations come in. Now, as long as interest rates remain elevated for an extended period, which we expect they're going to do, banks are going to, enjoy higher net interest margins, and that's going to certainly feed down to the bottom line. The valuation reduction really comes from the capital market side that's shrunk. Going forward into a recession, potentially a recession, the chance is that loans volume comes down a little bit. But investors, are forward-looking. Right now, if there is a recession, it doesn't look like it'll be a particularly deep one, given strengths in other areas of the economy, given the low real price of energy, for example. And so, it looks like we're sort of at almost the worst moment when the probability of recession is the highest. And then, you look beyond the recession and banks become an awfully good place to be, given those net interest margins likely to stay higher for longer.
Such a crazy moment in this market, Lisa. I was talking about this with Greg Staples at DWS yesterday. We're both discounting a recession and the recovery to that recession in markets, yet we haven't had the recession at all yet. It's kind of a bizarre situation, isn't it?
Which is why people are saying, don't get ahead of your skis. We haven't seen the pain yet. You can't price it out. You can't factor it out. But John, at what point do we understand what to even begin to? And this is a reason why I was talking about Stephen Major, just because the range of outcomes, how do you account for probabilities and scenarios that seem to offer opposite kinds of results?
Savita Subramanian with Bank of America wrote this in her outlook for 2023. The market is hoping for a Fed pivot, but it really shouldn't. A Fed easing cycle amid tightening credit conditions, i.e. recession, has been the worst backdrop for stocks. Joanne, can we finish there? Can you speak to that? Your thoughts on that comment from Savita over at B of A?
Yeah, I think our view is that the Fed's going to have to raise rates at least a couple times more, and look for 5% top, something like that. And then they're going to hold there for a while because it's going to take a long time for these rate increases to feed through to reduce those inflation pressures. Those long and variable lags, right? Nobody knows how long and how variable. And so, yeah, the chances are, right, economic activity slows down. We know that earnings numbers are going to come down. On the other hand, as you guys were just discussing, investors should be in it for the longer term. Recessions are always temporary. And so when you look at around the market, the broad market isn't particularly cheap, but there are an awful lot of stocks that have become cheap. And so this is an opportunity to get some stocks into the portfolio, some of which are even trading, in the single digits that are really solid companies with solid balance sheets.
But
and
Joanne,
some of them even provide income.
Before we let you go, a lot of people would push back against what you're saying. And this is a new regime, they would say, where we're not seeing zero rates anymore. We're not seeing free money. We're seeing QT that's potentially going to accelerate. Can we rely on past history to dictate future results of 5 years actually being a good investment if we are in a new regime change?
Yeah, Lisa, that's a really good point. In fact, we caution people not to use history as too much of a guide because this situation is really quite different. One of the biggest problems the U.S. economy faces that is a longer-term threat is a labor shortage. And whether that's because of lower birth rates, whether that's lack of immigration, legal and illegal, it does create a different environment. But when you look at what drives economic growth and therefore, companies' ability to sell and generate earnings, those growth engines, besides the labor shortage, are still in place. Innovation, productivity has been low growth recently. But when you look at the inputs to growth, whether it's computing, robotics, healthcare advances, all of those things are still progressing in the U.S. economy. So even though on the monetary side we're in a tough spot with this high inflation and rising interest rates to combat it, overall the underlying fundamentals of the U.S. economy are pretty strong. And so that's why, it gives us confidence that the 5-year investment plan is still a really good target to think of as you're planning your portfolio and your ultimate, retirement plans, that sort of thing.
Joanne, wonderful to hear from you as always. Joanne Finney there of Advisors Capital Management, looking ahead to 2023. Just looking at the ECFC function on the Bloomberg terminal, which just gives you a snapshot of the estimates for growth in various countries. And I've picked out America for 2023. In that survey of ours, Lisa, 0.4% is the forecast for GDP next year, just 0.4%.
Will it even be that? I mean, that's what a lot of people are wondering.
That's part of the conversation for sure.
Exactly. But it's definitely, and it's global too. I mean, you're seeing this around the world, and this has to do with China. This has to do with a lot of things that also are very uncertain.
David Rosenberg is on growth. Looking forward to that conversation with him a little bit later. He's got a lot to say about how quickly inflation might fall as well. The chief strategist and economist at Rosenberg Research, coming up at 7:30 Eastern Time. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and House Speaker Nancy Pelosi are moving forward to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor settlement despite the objections of some unions. A rail strike could hurt the economy by crippling supply chains. OPEC and its allies are expected to consider deeper output cuts when they meet this weekend. Saudi Arabia and partners surprised traders when they announced a 2 million barrel a day cutback last month. Still, prices have faltered since then as demand weakens. European Union talks on a price cap on Russian oil exports remain stuck. A cap of as low as $62 a barrel has been discussed. Poland and Baltic states say the price level is too high, but shipping nations like Greece and Cyprus want it higher. The price cap is designed to keep Russian oil flowing, while at the same time limiting Moscow's revenues. Former Vice President Mike Pence is calling on Donald Trump to apologize for having dinner with a white nationalist. In a TV interview, Pence said the former president showed profoundly poor judgment. Last week, he dined at his Mar-a-Lago resort with rapper Ye and white supremacist Nick Fuentes. Billionaire Elon Musk is publicly attacking Apple in a battle that pits the owner of Twitter against one of the company's top advertisers. Musk says that Apple has cut its Twitter advertising and threatened to block the social network from its app store. He also accused Apple of hating free speech. No comment yet from Apple. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
It's certainly possible that the zero COVID ends early, and that would be a game changer. But it's just as possible that the clampdown comes, uncertainties stays, supply line problems rebuild, and it just causes more economic slowdown out there.
Great to catch up with Brian Weinstein there, the Morgan Stanley Investment Management Head of Fixed Income. Live from New York with equity futures just about positive on the S&P 500, up 0.2%. Equities pushing higher. Bond yields lower by a couple of basis points, 365.71 on a US 10-year. Euro dollar 103.75. In about an hour and 10 minutes, you'll get CPI data out of Germany. We've had the regional breakdown so far. Downside surprise after downside surprise across Europe this morning on inflation, so that's worth a look. Just about hanging on to the 70s on WTI crude, 79.17, call it 79.20, with positive 2.5% on crude this morning. Tweet of the morning so far. So what did China announce today, or are we using markets to imply that something was announced?
It's a good question. They did indicate that they were willing to increase some of the motivation to get the vaccines, and that seems to have generated some encouragement. Perhaps also we're not seeing as many protests because they were all cracked down upon.
And Karen joined us now, Bloomberg Chief Asia Economics Correspondent. And what has been announced in China overnight?
Well, they're getting to the Achilles heel that we've talked about in your show so many times. They came out today and said we are going to boost vaccination rates, especially among the elderly across China. Now, they said they're going to target nursing homes. They said they're going to use big data to try and get to those people who have not been vaccinated or in short of boosters. The coverage of boosters on indeed vaccinations over the age of 80 is really not where it needs to be. It's about, in fact, for those over 60, it's about 70% total coverage. Now, so that was a big announcement. But what they did not come out and announce were specific measures like enforced mandates or other kind of, carrot type approaches to get people to go out there and get the vaccine. There has been some reticence among the elderly in China according to our reporting, for example, there fears of side effects. There's been a view, some could call it rational, that there was no need to get vaccinated when there was no COVID in the country. Obviously, that situation has changed, and it does feel like it's reaching a point now where China is realizing it has to get its vaccination rate where it needs to be, and B, they're starting now the first steps of what's probably going to be a very complicated journey to try and prepare the country to reopen the economy and link it up with the rest of the world.
Is it fair, Enda, to think that this is preparation for an earlier exit to COVID-0 than perhaps was previously signaled?
It's a fair question to ask, Lisa. We just don't know for sure. What we do know is the authorities came out with that 20-point plan a few weeks ago. They are, basically crawling their way along this process to try and ease up restrictions where they can, but also try and control the virus, which of course is a very difficult thing to do. We know the economy needs to be allowed to get back on its feet, so they have to try and somehow pull out of this COVID-0 approach the way they are. But what we do know is, as a matter of fact, China is at risk of a serious public health disaster. That continues to be a major constraint for them, but they don't yet have the hospital network ready to deal with the kind of outbreak that experts talk about. They don't yet have the vaccination rate where it needs to be. There has been criticism, of course, that they need to embrace other kind of vaccines from the Western world as well. There's a lot that China needs to do to offset the public health disaster. So I think most people watching this today are saying this could be the beginning of the end, as one analyst described it, but it's probably going to be a pretty complicated road from here, I think.
And we think about some of the protests overnight being squashed by the authorities today. We heard about that. That doesn't seem to be the motivation of Xi Jinping's party. Right now, we're looking at companies, including Volkswagen, that are removing some of their factories or taking them offline in China because of some of the supply chain kinks, some of the issues with supplying those factories. We're also hearing the U.S. push European allies to take a harder stance on China. How much is that factoring into the speed in which China would like to move away from this policy?
You would have to assume it's part of their rationing, their thinking on this, Lisa. Multinational corporation sentiment towards China is very negative right now. The chambers of commerce routinely come out and criticize China's COVID-0 policy, or at the very least, they ask, what is the roadmap out of this? That's very unusual to hear these kind of commentary from the European chambers and the US chambers. And you're right, supply chains are being disrupted. We saw that recently, of course, with Apple. And there certainly has been some dislocation of the supply chain out of China into neighboring countries. So when you consider the optics and the negative sentiment towards China, and when you consider the downward pressure on the economy, one would assume the policymakers, of course, don't want to lose that foreign investment. They don't want to lose those foreign companies and all the big employment that go with that. And it has to be a factor in their thinking. It's all part of getting the economy back on its feet.
And the consumer base in China is incredibly powerful. And I think we forget that sometimes when we have these discussions. Can you tell me how they could respond to, say, a company like Apple relocating its production base? Do you see that kind of nationalism underpinning consumer decisions?
Well, in the past, certainly there has been nationalism in terms of unofficial boycotts of chain stores or products from other countries, whether it was because something was deemed to be offensive to the Chinese people, or whether it was because of a geopolitical spat. For one reason or another, there have been, trade has been weaponized at times by China in an unofficial way. So you cannot rule out that if a company was to pull out of China on a broad scale, that there wouldn't be some kind of retribution. But this is where it gets complicated, John, because some of these very large multinationals, when you speak to them, they will complain about COVID-0. But on the other hand, they will tell you, well, where else do you go that offers the scale and the scale of infrastructure that China offers, where you can plug in and get up and running? There aren't many countries around the world that offer that right now. That's one of China's key defenses. The other side of the consumer story, don't forget, it isn't just COVID. It's the real estate slump. That's still 1/4 of the overall economic output. That's a big part of what's happening too.
Yeah, well said, Enda. Appreciate that final comment there. Enda Curran there of Bloomberg out of Hong Kong. And Lisa, we need to talk about that as well. It's not just been a COVID-0 story that's dragged down growth in China.
But how much has to do with the fact that people don't have the income in the same kind of way, don't necessarily have some of the enthusiasm? That said, this does come with a time of tightening, right? This was a nation that was trying to remove some of the liquidity that really built up and generated some of the growth that really drove the world economy. They've been retrenching, moving away from that a little bit in the face of some of the slowdown that we've seen recently. But right, this is a country that in a massive inflection point in a lot of different ways. And how do they navigate out of COVID-0 and keep companies there that are having a really hard time?
Growth in China, 8 handle last year. This year, just about holding on to 3.3% is the estimate for 22.
Can it get back up next year? I mean, this is the one consensus in a lot of different outlooks has been China will be the bright spot next year because it's got to get better than this year. How quickly can it do that, especially if Enda's correct, and I'm sure he is, that it's going to be a very difficult road, and keeping companies is going to be tough.
The estimate in our survey is 4.9%. Of course, this all hinges on what happens with, for next year, for 23. There's a massive asterisk next to that number, and it basically comes down to what they will or won't do with COVID zero.
Okay, I'm going to be sort of delicate, but not really. But
do what you want.
I mean, do you think that people are really honest in their assessment of what's going to happen next year? Do you think it's kind of clouded? Let's be optimistic so that we can sort of preserve face in a nation that's going to penalize us for being
Is
too
the
negative.
South Side compromised when it comes to analysis around China?
I mean, we've heard that from...
I've heard that from a million people.
A ton of people.
Over the last 10 years, sure.
That we never see the actual figures. Will that change because this is an administration that's actually putting out some real figures or closer to real figures? Maybe? I don't know. I just, there has to be an asterisk around it. There does.
And there always is. Coming up in the next hour, 7:45 Eastern, Bill Dudley, the former New York Fed president and Bloomberg opinion columnist from New York. This is Bloomberg.
NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration, the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
yield curve, the labor market, and risk assets are all saying very different things at the moment.
We're all subject to the data.
Inflation is what the Fed's going to focus on.
It's hard to see inflation pressures easing off completely.
I don't think we're going to see inflation neatly fitting back into this 2% box anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Lots of World Cup talk coming up.
Really?
Yeah, no, that's the promo. That's how we're starting. That's how we're starting the show.
Okay.
Live from New York City this morning. Good morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance. Equity futures up by about 1/3 of 1%. I think we can call this some kind of a bounce back, but only a marginal one off the back of the news in China over the weekend. And did we really get a big announcement from the Chinese authorities overnight? There's going to be a push. It's a vow to make a push towards vaccinating more people.
It's a nod to the biggest question mark that a lot of people have had, which is how do you prepare your population for the end of COVID-0? This is the first steps to it. What that means in terms of expediting some sort of exit of COVID-0, we have no idea.
Massive consequences for 2023.
Yes.
Huge. And I don't even think we can really have a conversation about the outlook for 2023 without that conversation. The other piece of it, of course, is the Federal Reserve, waiting for Chairman Powell tomorrow, waiting for the data as well, going into Friday.
Does anything that Fed officials say really matter? We heard hawkish talk after hawkish talk over the past 24 hours. Bullard, Mester, name your Fed official that spoke, which is pretty much all of them. And they all say the same thing, which is we might slow the pace, but we're still going to go to a higher terminal rate. We're going to keep it there for the duration of 2023. John Williams saying this too, of the New York Fed. And yet we're still seeing rate cuts priced into this market because the market is looking past what the Fed is looking at. The market is looking past what the data is showing and is going to that faith, that stealth-faith, and transitory for inflation.
Binky Chara at Deutsche Bank had a really interesting note in the last week, and he discussed this on this program a number of weeks ago. Can you blame higher rates? He said this: equities are where they were 175 basis points ago in rates. The S&P 500 has been at recent levels 4 times over the last 5 months, while rates have been successfully and notably higher each time, with the 2-year yield up 175 basis points from the first time, suggesting it is not higher rates that drove the equity sell-off. What do you make of that?
That's what I mean. I think that there is an argument that it is not the rate picture, it's the growth picture. And until it really affects how companies operate, it's not going to have material effect on stock valuations. I don't buy it because I think that, and I'll be honest, I don't buy it, and that's the reason why I kind of grunted, but you have to think about the relative valuation proposition. There are people who are suddenly saying, what, Tara? There are relative alternatives
I just love that
or whatever.
You felt the need to tell us you don't buy it, as if we didn't already know based on that pause and that noise you made.
Come on, you're the one that was saying, I'll tell you what I think in the break. I think that you tell us on air quite often.
That's the sanitized version.
Yeah, and otherwise it's just a slew of expletives. I do think, though, that, there is a point being made here, which is we have not seen the effect of rates where they are the way that many people thought previously.
I want to do a podcast where you can curse. You can curse about markets, and people can just really say about how they feel about
I think a lot
things.
of people listening. I think a lot of people listening.
Cathartic, wouldn't it? I agree. Futures positive 1/3 of 1%. No one here at Bloomberg's going for that. About life if you want
exactly.
as well.
There you go.
Equities up by 1/3 of 1%. Yields look like this, down 3 basis points, 365.34 on a 10-year. Look out for German CPI coming up in about 57 minutes from now. Had a downside surprise out of Spain, and looking at the regional breakdown of Germany, pretty soft inflation prints relative. I stress relative to the previous month, though in absolute terms still elevated and something the ECB will be concerned about. Euro dollar, Lisa, right now 103.83.
Yeah, I'm looking right now at a 10-year German yields that is sharply lower, 1.88%. And this really does speak to the downside surprise that we may be expecting in less than an hour's time. 8 a.m. we get that Germany inflation read for the month of November. How much does it matter how much it comes off if it really is due to energy, given the volatility underpinning this? I'm more curious to hear the analysis of the other drivers of employment, of other consumer goods, of wheat and other areas. That might be more telling in terms of more protracted inflation. 9 a.m., we get housing data. I'm not allowed to say the name of this one because it's too long. Okay,
by all means, say the name.
There
I
we
just
go.
think it needs a rebrand.
And you can just do like a sort of underpinning of a beat of expletives. S&P CoreLogic Case Shiller 20-city home price index for the month of September. How much does it roll over? You're right, it needs a rebrand. The S&P 20-city data set is going to come in, and can we see a real rolling over of house values, or is this just a softening in the pace of how quickly they're going up? We are looking for some sort of disinflationary kind of feel and potentially even deflation. At 11:30 a.m., I think this is going to be interesting, a news conference from Jens Stoltenberg of NATO. He's going to be talking about Ukraine and ongoing support, but also China. And we're seeing a lot of pushback from U.S. saying, look, European allies, we have to have a cohesive energy and a cohesive strategy when it comes to dealing with China.
Lisa, thank you. Looking forward to that. Joining us now, I'm pleased to say, is Evan Brown, Head of Multi-Asset Strategy at UBS Asset Management. Evan, always fantastic to catch up with you and the team. Let's just start with the core theme for you guys, which is that you think investors are going to be surprised by how resilient this U.S. economy will continue to be, perhaps deep into 2023. Evan, can you walk us through the why and for how long you think we might be surprised?
Yeah, so I think for one, we're in an environment where you still have a lot of excess savings on household balance sheets in aggregate. So we know that those excess savings are dwindling somewhat for some of the lower earners, but the biggest spenders in the economy are higher earners. You still have a very tight labor market for those lower earners, lower income earners, plus, and I think this is a very big deal, a big decline in gasoline prices. That's going to be a big support for the U.S. consumer. You've got a Social Security adjustment, cost of living adjustment that's going to effectively boost incomes. The states have a lot of excess savings themselves, and there's direct support for consumers coming through there. So what we're talking about is a reasonably healthy economy despite all the rate hikes that we've seen today.
Can you be just as constructive on earnings?
Yeah, I mean, I think as inflation comes down, that's going to weigh somewhat on earnings. But I think a lot of that is known, right? A lot of that, even if you haven't seen analyst expectations come down as much, everyone's talking about recession. Everyone's talking about earnings coming down. And so the surprise is that they hang in there, right? We're not talking about a boom in earnings. They're definitely coming down, but we are talking about them just hanging in. And at this point, that's probably enough.
Do you think we could see the outcome for 2023 flipped from what people are expecting, which is a good first half and a really bad second half?
It could be, because I do think that the tightness of the labor market can continue, and that's going to keep the Fed on edge. There's a lot of narrative right now that, okay, the Fed's going to do another 50 basis point hike, another 25 basis point hike, and more or less be done. But if the labor market is staying tight, then there's a bias that the Fed has to, kind of extend and do a few more 25 basis point hike. Can we get to a 5.5–6% expected terminal rate? I think we can. And ultimately, that can be the thing that makes the economy crack down the road, but it's too early to trade that right now.
What does that mean in terms of the bond trade, given that so many people hid out in the long end? Does that mean that that could be fine for now and we could see that work for another couple months? But if we go to a 5 to 6% benchmark Fed funds rate, all of a sudden that trade gets blown up.
Yeah, I think that's right. I mean, I do think a lot of the bond rally is a result of people kind of short covering. Everyone's been short bonds for a long time. And I think a lot of it, too, has been the round trip that we've seen from the UK transitioning from fiscal stimulus coming from the Truss administration to now Sunak and fiscal austerity. So that's putting downward pressure globally on yields. But all of that is kind of played out. And now we get to the point where, growth is okay. Inflation is sticky. Fed might be doing more than people expect. And then right out there, you have the Bank of Japan, right, which at some point next year, probably in the first half, is going to be adjusting. And even if that's kind of known, that's really that last anchor that there is on bond yield. So I think almost even psychologically, that's going to be injecting some term premium in bond markets and perhaps leading to a renewed sell-off in duration.
Evan, if that's the case, where does that leave the dollar trade? Because I'd pick up on cable, you mentioned the UK, that went from 103.50 intraday lows of the year on September 26th to 120 right now. Similarly, we've had a turnaround in euro dollar as well. Evan, are you saying that dollar strength can kick back in too?
Yeah, I think it'll kick back in, but not to the same extent that we've seen for the bulk of this year. And the reason being that Europe, we all know that they're in recession or about to be in recession. they're going to be bouncing back. In fact, you're already seeing the confidence measure, consumer confidence, business confidence measure stabilize, and in some cases turn. So you should get, on a forward-looking basis, a little bit of bounce from Europe. You know, China, the path is bumpy, leaving zero COVID, but the destination is reopening. I mean, they're going to have to reopen in order to make sure that the economy just doesn't completely fall apart, and that the government has the tax revenues to actually pursue their policies on common prosperity and redistribution and the like. So the current situation is unsustainable in China, and so we'll pick up there. So if you're getting, you know, more support from Europe, more support from China, it's not just a U.S.-driven economic story.
Evan, final forecast we want from you. Team USA against Iran, 2 p.m. Eastern Time. What's the score?
The U.S. is going to win 2-1. That's you can count on that.
There we go. There we go. UBS, you see, UBS likes to play ball. What was PIMCO about earlier?
You know,
baseball chat.
They're playing a different ball.
Baseball banter.
Yeah,
What's
I mean,
that?
well, okay, what's your projection? What's your prediction for the game?
Well, I'll tell you what I hope. I hope Team USA progresses.
No, I mean the score.
And I'll go with Evan Brands 2-1.
You think you're going to go with that?
I'll go with Evan Brands 2-1, sure.
I'm going to do 3-1.
3-1, nice, okay.
You want to put money on it?
If you want to. I mean, does the money go to charity? I don't like to gamble.
No, I know, I don't either.
I don't gamble
Have you ever done
at
a
all.
slot machine? Someone once paid me to do a slot machine. It was
I
not
would never
satisfying.
I did horses back in the day.
Really?
Yeah,
I
sure.
can see you. And you do, you know, Formula One, no?
I don't gamble on it. You know,
Right.
I used to bet on some horses.
Really?
Sure.
How much money did you lose?
I don't gamble anymore, all right? Bill Dudley joining us in about 30 minutes' time. Looking forward to it. Live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers are stressing that more interest rate hikes are on the way to curb inflation. New York Fed President John Williams told reporters that he sees rates heading somewhat higher than he had forecast just a few months ago. Meanwhile, St. Louis Fed President James Bullard says that markets are underpricing the chance of higher rates. China plans to increase COVID vaccinations among its senior citizens. It's a step that health experts regard as crucial to reopening an economy stuck in harsh COVID-0 restrictions. Still, Beijing stopped short of announcing mandates that helped raise inoculation rates in other countries. The move comes after a weekend of protests demanding an end to COVID limits. HSBC has agreed to sell its Canadian unit to Royal Bank of Canada. The price, $10 billion in cash. The deal will allow RBC to expand its roster of business clients and bulk up its retail presence on the West Coast. The transaction represents a rare domestic acquisition for one of Canada's big banks. And in New York, the Transportation Authority may have to raise fares or reduce service on subways, buses, and commuter trains. According to State Comptroller Thomas Napoli, the agency's current financial plans are insufficient to close long-term budget gaps. Weekly ridership around 60% of pre-pandemic levels, and the transit agency faces a $500 million deficit in 2025. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in In any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion, they're chasing green, blue hydrogen, they're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is a critical time for our security, and we are sending an important message. NATO is here, NATO is vigilant, and NATO is ready to defend every inch of Allied territory.
Jens Stoltenberg there, the NATO Secretary General, live from New York this Tuesday morning. Good morning to you all. Equity futures are just about positive, up 1/3 of 1%. Yields are coming in just a little bit on a 10-year, down 2 basis points, 365.71. I'll talk more about the European bond market a little bit later this morning off the back of a downside surprise on Spanish CPI. Euro dollar at the moment, 103.74. We're down about 1/3 of 1%, up 1/3 of 1% rather on that currency pair. The euro showing just a little bit of strength. Lisa, you mentioned a news conference coming up with Jens Stoltenberg. What time was that?
11:30 a.m.
11:30. What are we expecting from it?
I'm curious to hear not just what they're going to do in order to provide Ukraine with support, but also with respect to China and how the West is trying to reduce reliance on China, because we've heard that much more clearly spoken over the past couple of weeks.
Let's get you some team coverage. Joining us now is Bloomberg's Anne-Marie down in Washington, D.C., together with Maria today over in Bucharest. Maria, let's begin with you. What are you expecting from the NATO Secretary General a little bit later?
Well, Jonathan, I already had a preview because I was at a panel in which he assisted and spoke, and there were two things that he repeated time and time and again. One, NATO is the biggest military alliance. Perhaps that is a message not just to Russia, but also China. He also appealed to allies for a full comprehensive package of assistance for Ukraine. And right now, this is not just money and weapons, but also winter equipment. This country is already under a lot of pressure because of the low temperatures. And then something that that to me really caught my eye, and he suggested, well, we should learn the lessons from Russia and perhaps apply them to other autocracies like China. We should reduce our dependencies from countries that clearly do not share the same values.
Well, and Maria Tadeo, this is really an issue, especially as you hear Volkswagen pulling back and actually closing down some of their factories in Russia, saying it's because of supply chain constraints, because of materials that they cannot get. Is this a stealth way, a good excuse for certain industrial companies from the West to withdraw from China? Is that what we're actually seeing?
Look, it is hard to tell because on the flip side, there was also the German chancellor who went over to China a few weeks ago with a bunch of CEOs also, again, on that trip, official visit. But there is also right now in Germany a rethinking about essentially what was their foreign policy for decades. And that is that the more you trade, the better relationships that you have, and therefore diplomatic ties will improve with Russia. That entire playbook that Angela Merkel applied for years have gone out the window. They did a lot of trade with Russia, they got burned, and now you have a war. So I think with China, with respects to Germany, there are tensions within the coalition, how to treat the Chinese, but also overall in Europe, there's this idea that perhaps, yes, you have to decouple from countries that do not share your values, or at least not be as dependent, to not be in a situation like the one we're in right now, in a perfect storm, high energy costs, still dependent on Russian supplies, a massive diplomatic fight over the oil and gas cap, and of course, inflation still being a problem.
Anne-Marie, how united is the West when it comes to moving away from China, moving away from Russia?
Well, I think Maria really speaks to the tension that you see. On one hand, you do see companies and you do see the West wanting to diverge and divest away from China. You see that with Apple moving some stuff to India. You see that with the U.S. trying to drum up support at home when it comes to chip manufacturing. But at the same time, you have Chancellor of Germany, Olaf Scholz, going over to Beijing recently to make sure that those economic ties, and by the way, he was flanked by all the most important German executives and their companies like VW, et cetera. And then you have Emmanuel Macron also heading himself to China. So there's this issue where they're dealing with the economies that they are dealt with. This was, as Maria said, this is what Chancellor Merkel really had for years. The Germans really rely on China when it comes to their economy, the same way they relied on cheap Russian gas when it comes to their manufacturing. This is something that is going to take years to unwind, but you do see the start of it. But at the same time, it's not just going to be like switching off a light switch.
MH, how do you think this is going to play out between Macron and Biden later this week?
Well, when it comes to Macron and Biden and this state visit, what is really going to be on the agenda is what Macron has recently called the U.S. Inflation Reduction Act and those climate subsidies that they're giving to U.S. companies only. He said that these are unfriendly practices, and he says that they're calling this protectionism. And this is something that the Europeans really behind the scenes want to work out the United States. But also to show a little bit of a fractured environment in Europe, you have the Germans who are saying we need to deal and communicate with the Biden administration, and we should not start an inflation trade war. So they're actually more welcoming a little bit of what the U.S. is doing, the Inflation Reduction Act. Very different stance than how France has been taking it. And this will be the main topic as President Macron visits Washington this week.
Anne-Marie, final question. Who goes further, Team USA or Spain?
Oh gosh. Maria's going to be upset with me, but I'm obviously rooting for America.
Oh, yeah, you're just trying to set
Today
this up.
I'm so fired up about this.
Oh, I know. That's why you're basically just setting her up.
Have you seen Maria out on Twitter?
Yeah, are we going to let her speak or no?
Do you think Maria needs permission?
Go ahead, Maria.
The fact this was even a question, I just cannot. I can't.
She's speechless.
I need a moment. Let's go to commercial. Just back to you guys.
Let's go to commercial. I'm just going to get
That's the tension between Spain and Washington, D.C. right now.
That's not about Spain and Washington, D.C. What are you doing? All I could say is that she'd have a field day on that podcast that you're going to do where you can curse. I think that she'd
They
come
would
in
be
and
my
talk
first
about,
guess.
Yeah, Madrid.
Tadeo and AMH.
I actually watched
talking about the World Cup.
Spain versus Germany.
They play really nice football.
They play a great game, and they are young. She's right, and they're good. I'm
They are
impressed.
good.
They are
They
really
are
good.
good.
Gavi was excellent. That was fun. She's
Oh,
very
you like
pro
Gavi?
I mean, there are others that are very good too. I mean, it was really a great game to watch.
I'm pleased you watch it. Look at the shape of Spain, the way they play football. It's really interesting. They'll always have someone on either side of the wings, pinned to the sidelines. And it's the way Barcelona plays football. They really stretch out defence. So you see Dani Olmo on the far side and Torres on the other side. And they're always there in position whenever they've got possession.
It's a fast passing game. I like that. And just sort of the idea of one team moving as one, even though they're continually passing. It was impressive.
Yeah, some people find it very boring as well, because it's just sort of like, you know.
I like that. It's chess.
Maria likes it too, clearly.
Yeah, she has lots
very
of things
fired
to
up
say.
about.
Yeah, you knew
this
this.
team.
You were just setting her up.
No,
It
I'm
was so
shocked. I thought
obvious.
she'd be more diplomatic about it.
You thought
That's
that she'd
why I
be
asked the
less
question.
diplomatic. That's what you really thought.
Coming up, David Rosenberg, looking forward to that. The founder and president of Rosenberg Research. A must-watch, must-listen conversation just around the corner. Did I get to say thanks to Anne-Marie and Maria? I don't think I did.
I think we should say it again. Thank you.
Anne-Marie, today, to the both of you, thank you. As always, equity futures shaping up as follows on the S&P 500. Team Spain playing in a couple of days. We'll get Maria's thoughts on that.
Just follow her on
Bloomberg
Twitter.
surveillance. If she comes back, I mean, she's very unhappy off the back of those comments. Equities up 1/3%. Yields down a couple of basis points. 366. She wasn't joking.
Did you see her eyes?
Oh.
She was really angry. She's like, I can't even be on this. She almost ripped off her
I don't
microphone.
even want to be on this show anymore.
I basically go to break. I don't really care. Like, I don't want to be on with you guys. That's basically what it was.
Hey, she's not the only one, is she?
No, probably.
No. That's why Tom's still off.
He basically ripped off his microphone and said,
I'm not coming back.
Forget it.
From New York, this is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
So you got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Live from New York, trying to bounce here on the S&P 500 by about 1/3 of 1%, trying to bounce back from the biggest one-day loss on the S&P, going back to November 9th, up about 1/4 of 1% now on the S&P. On the NASDAQ 100, up 1/2 of 1%. In the bond market, deeply, deeply inverted yield curve. The 2-year versus the 10-year, negative something like 80 basis points. At the moment, 443.40 on a 2-year. Yields lower again on a 10-year to 366, so more curve inversion for you. And a bit abroad as well, in Europe. Firmer bond markets in Germany, in Italy, off the back of downside surprises on inflation in Spain and potentially in Germany in about 30 minutes' time. We had the regional breakdown in Germany, as we often do on CPI, a little bit earlier this morning, indicating you could get an easing of inflation in Europe as well. So your 10-year comes down 10 basis points in Germany, down 15 in Italy, and the euro, Lisa, a little bit stronger.
How much is it a head fake? Is it just having to do with energy prices, and can people shrug this off?
Don't know is the short answer. The ECB's in a tough spot. And that's the bigger debate when the ECB convenes on December 15th. And we've talked about this a few times. Inflation's still pretty elevated in Europe. A lot of that is the energy story. It's not the same as what's taken place here in the United States. And the ECB is hiking into a downturn. And they're set to do it again in a couple of weeks' time. Maybe the debate goes away from 75 and towards 50, a little bit like the Federal Reserve off the back of this data, but still, double-digit CPI there and thereabouts.
And how much really confidence can people give to the disinflationary kind of force? How much confidence can people give to what we heard overnight in China as well, in terms of emphasizing vaccinations, particularly for older residents of China? And this really has been driving massive moves in certain Chinese ADRs that we're seeing here, including Baidu, as well as Alibaba. You could see those shares flying ahead of the market open, up 5.5% for Alibaba, and Baidu is up 6.5%. And I also, those are some of the things that I'm looking at. I'm also looking at Ferrari because it is one of the main stories of the day. Those shares are down 0.5% after the resignation of team principal Mattia Binotto, who, you know, has been there for a long time, a real leader. I'm going to try to pretend
Scuderia Ferrari.
Yeah.
This is the Formula One team.
Carry on. Yeah. I mean, honestly.
Well, they had a disappointing year. Fantastic car.
Yeah.
Super fast. Terrible strategy. They should have dominated the first half of the season. You saw how many poles that Charles Leclerc got and ultimately didn't convert them into wins in the way he should have done, and certainly not like Max Verstappen did. And Red Bull were dominant again, so I'm hoping Ferrari turn it around.
So you're glad?
I'm happy about a couple of things when it comes to sport. I'm happy that we're getting more buy-in to international football. Can I call it international
You're trolling me on air.
No,
Go on. Okay.
And I'm also really happy that we're finally getting buy-in in America to Formula One as well. That's been a huge change over the last 12 months, largely off the back of the Netflix series, I know. But we're going to have a number of races here on the calendar next year. I believe Vegas is coming as well, Miami, Vegas.
It's an easier crossover, though, because of NASCAR. I mean, it's an easier...
NASCAR's been a thing that's held people back from converting to Formula One.
But I think that, you know, it's equal opportunity, especially after sports.
I'm pleased you brought that up. That's great.
I mean, I just, you know... I'm just trying to make you happy every day.
Are you looking at Juventus as well, or no? Just Ferrari?
Let's move on.
You're done?
Yeah, I've moved on.
You've only got 60 seconds for me to talk Formula One. Okay.
Carry on. You want to go?
A number of weeks ago, Patrick Harker of the Philadelphia Fed said something really interesting, and Mike McKee picked up on it. He referred to inflation. He said it could go up like a rocket and down like a feather. And we've got a conversation coming up now with a man who I think disagrees with that point of view. David Rosenberg joins us, the founder and president of Rosenberg Research. David, fantastic to catch up with you, sir. I think that's where we should begin. This idea that it can go up very quickly and inflation can be much stickier on the way down. David, do you push back against that, and why?
Yeah, I push back on it because I heard the very same things, you know, when I was at Mother Merrill back in the summer of 2008 when we had the Chinese commodity super cycle and global decoupling, and inflation at that point was pressing against 6% because oil was running up to $145 a barrel. And we went from 6% inflation in the next year, the summer of '09, we were down to negative 2% year over year. And it wasn't because of services. Service sector inflation is always sticky. Service sector pricing never deflates. And that's what people tend to focus on. That's what the Fed's focused on, or on the rental measures, which dominate the CPI. But, 40% of the CPI are goods, the stuff you can see, touch, and feel, that you're starting to already see the signs in the commodity markets, and the lagged impact of the strong dollar are starting to create deflationary forces in that 40% chunk. So everybody who's hawkish on inflation looks at the rental side, and of course, everybody knows that there's lags involved in terms of how that's constructed in the CPI. But in real time, we're going to be seeing some significant deflation in that 40% of the CPI called materials. So when he talks about that inflation can't come crashing down, there are already measures in real time that are crashing down. I mean, oil is down, 35% from the peak. Copper's down 25%. Most shipping rate measures are down roughly 60%. Those were actually the factors that precipitated that rocketing up of inflation, came out of the commodity markets and came out of the supply bottlenecks that had a big impact on transportation costs. Those have gone into major reverse. They're not falling like a feather, okay? They're falling like a stone right now. And that's going to show up, I think, forcefully in the CPI data between now and 12 months from now.
David, falling like a stone to what? What is the level that you see it kind of remaining sticky?
Overall inflation, I don't think it's going to be, altogether that sticky. I think that we've already peaked. When you're taking a look at some of the leading indicators, like the pipeline measures, core intermediate PPI, core crude PPI, they are actually not just decelerating, they're deflating. And that's going to create downward pressures on the good side of the CPI over the course of the next year. I actually think that we will be either at or below 3% on headline CPI year over year by this time next year.
People would push back pretty vociferously, including a lot of Fed officials, particularly with respect to the labor market that continues to be pretty tight and continuing to see wages increase pretty significantly. How do you view that and pair that with this disinflationary view that you hold?
Well, what I find interesting about the Fed is their prevalent focus on lagging indicators. You mentioned wages, for example, unit labor costs. They're in the Conference Board's index of lagging economic indicators. Wages lag the cycle. In fact, you could argue that inflation lags the cycle. It usually peaks and goes down 6 months into the recession. The labor market is tight, but it is starting to loosen up. And the labor market is always tight. You always have either a 3 or 4 handle on the unemployment rate at the peak of the economic expansion. My sense is that, the Fed's already told us that their forecast for next year is the unemployment rate to go to 4.4%. Depending on what the participation rate does, I think we're going to head up towards 6%. So this is a situation, where your forecast, your assumptions drive your forecast. I think that we're going to get much higher unemployment rate, and with a lag, that's going to create more discernible downward pressure on wages. And it's already starting to show up. When you're taking a look at some measures of compensation, yes, they're running hot on a trend basis, but they've started to peak out and started to roll over at the margin. And I think that's going to be a big theme. I don't think that, the labor market today is going to be the labor market next year any more than you could tell me at the peak of the 2007 economic expansion or the peak of the 2000 economic expansion when the unemployment rate was about where it is today, to basically superimpose that on the next 12 months in the context of recession staring us in the face. I think that these wage trends are going to be rolling over pretty significantly too.
David, what do you think the market consequences will be from all of this?
Well, I think that I'm taking a look at the stock market, and look, I'm waiting to shed my my bearish fur and turn bullish. But in all seriousness, you have a forward PE multiple of 17 heading into a recession, and you have analyst earnings estimates which have started to come down in dribs and drabs. But, you never had a recession where earnings were positive, and the consensus, and of course, the valuations are premised, the forward P multiples are premised on forward earnings estimates. They haven't really been cut that much yet. I think that for people that are buying the stock market at a 17 multiple, on recession earnings, you're really buying the market at over a 20 multiple, and that is just too rich for me. So I still am outright, I would say, cautious, if not bearish, on the stock market. And I think that the bond market's behaving extremely well here. I think the bond market is giving you a view that the Fed is already over-tightened. And my sense is that my strongest conviction call is the long bond for the next 12 months. I think that you will get returns there that you won't get in other asset classes. So bullish on treasuries, most detested asset class. I'm fine with that. But in a recession, and as it becomes more widely accepted and inflation comes down, I think treasury yields out the curve are going to be the place to be.
David, what do you think the character of that recession will be? The consensus view we hear a lot, you hear it a lot listening to this program, short and shallow, short and shallow. David, do you push back against that as well?
Well, the thing is that the same people that were saying that we're going to have the roaring 20s and there was not a recession on the horizon are now saying, oh, don't worry, it's going to be a short and shallow recession. I'm not so sure about short and shallow, but frankly, I don't really care because you could have forecasted a short and shallow recession in 2001 and you would have been dead right because GDP barely contracted. But you had overinflated asset values and you still ended up with almost a 3-year bear market in stocks, even with that mild recession. So a mild recession is not a get-out-of-jail-free card for long-only risk asset managers. And on top of that, we don't know the extent to which it's going to be mild or not mild. Here's the problem with the mild recession scenario. Mild recessions, you don't get V-shaped recoveries. At least in a sharp downward move in GDP, and you get the stimulus inevitably from the Fed, you get a V-shaped recovery. So I would ask those people thinking about equities as a long-duration asset, let's say we get a mild recession. What's the recovery going to look like? And then you have the Fed telling us that not only are they talking about the funds rate being higher, the terminal rate being higher than they were talking about, back in September, that now we're going to be north of 5%. And the Fed's telling you that no matter what, and remember, their forecast right now is 4.4% on the unemployment rate.
Yeah.
That would mean this cycle we would have risen almost a full percentage point, which has never happened without a context of a recession. So they're telling you implicitly in our forecast we have a recession. Oh, by the way, we are so retentive on the inflation side that we're going to leave rates higher for longer. So even when it comes time for the Fed to cut rates like they've done in the past in the face of economic strains, this Fed's not going to do it. So, okay, let's talk about short and shallow recession. The next question is, okay, what sort of recovery are we going to see? And it seems to me that without short and shallow recession and a Fed not stimulating policy, we're going to be bouncing along the bottom on the economy for an elongated period of time. I mean, ultimately, you're paying for growth as an equity investor. So fine, run with that view, short and shallow recession with no recovery, because we're going to have a still tight Fed well into next year, if not beyond. And so that means that the longer term outlook for assets, for long duration assets, are still going to be very challenged.
And you'll be in treasuries. That's all that's going down. David, this was wonderful. We could keep this going for a long, long time, but I'm told we can't because we've got to get to a commercial break. David Rosenberg, thank you. Absolutely fantastic. A lot to think about there, Bramo. A ton to think about. And the reason this guy wants to hang out in a 10-year is because that V-shaped recovery, if you're going to get short and shallow, ain't coming.
What if it's not short and shallow? What if it's long and shallow? What if it isn't necessarily steep, but it is something that is sustained for a longer period of time?
PIMCO, Tiffany Wilding talked about that.
Yeah.
She pushed back against that. And off the back of what David was talking about there as well, if you believe this Federal Reserve is not going to be cutting anytime soon, and if you believe in what they're telling us, which is they're going to keep rates elevated for a long, long time, then that should raise questions about the duration of the downturn.
That's what some people are saying. And what's more negative for risk assets? Short and shallow, short and steep, or long and shallow? And that's something people are thinking about over the longer term.
Bill Dudley's going to be with us in just a moment, the former New York Fed president. Looking forward to his thoughts. Coming up on Bloomberg Surveillance, live from New York. This is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive